you're seeing kind of everyone, I think, look to, okay, what else can benefit?
If we didn't have this boom in tech, we would be looking at a much worse situation.
The geopolitical is just not factored into anything right now.
To maintain the optimism, we need to continue to see earnings coming through.
The stock market's been remarkably strong, and I think it continues to do very well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, crude inching higher. The White House and Iran failing to break the deadlock as one key senator is opening the door to Kevin Warsh's confirmation the nation's capital reeling once again from an attempted attack on U.S. officials. We start this morning with a very warm welcome back to Lisa and Annmarie in the room on Saturday evening. I think we're all pleased to see you safe and well.
Yeah, well, right now we're looking at an evening that was torpedoed, and I think it's such a shame that we didn't have an evening that is done every single year for many decades. I will say the president came out with a sentiment that I thought was a nice one, which was that he hopes that this happens again in 30 days, because ultimately he wants to keep saying that one crazy person isn't going to torpedo the way we conduct our society. I think that everybody loves the sentiment. I don't know that everyone has the financial or emotional will to do it again, but there is this hope that it isn't going to wreck something that's become a tradition.
Well, during the chaos and confusion of whether or not the dinner was going to proceed, I spoke to a security official from the White House who said the president is adamant he wants to come back out. Obviously, he couldn't. Potentially, we'll see that in 30 days. Obviously, security is going to be front and center here. On one hand, the perimeter did work. These shooters, even though we didn't know it in the moment, these shooters did not make it to the ballroom, do not make it to that floor. But the shooter was staying at the hotel. Why wasn't the shooter's bags checked? Why wasn't there more security done on the outside perimeter, not just right before you go into the ballroom?
A lot of questions we need to answer. We'll catch up with Tyler Kendall a little bit later in the program. Also need to look forward to this. For financial market participants, the focus overwhelmingly on central bank decisions this week, Federal Reserve decision on Wednesday, and earnings from big tech through the week. And those big earnings all around Wednesday, Thursday, the majority of which land on Thursday afternoon.
Okay, just putting this all together, 44% of the S&P 500 market cap reports this week. If you think about the trillions of dollars that report with Amazon, as well as Alphabet, Microsoft, and Meta all reporting on Wednesday, and then Thursday you've got Apple, all of this coming together at a time where this market has rocketed higher, despite some of the concerns about the oil market on the hopes and dreams of AI. A key question for me is how will the market respond to increases in capital expenditure that do seem existential and frankly are all the more necessary as some of the component parts get more expensive.
And when it comes to the oil market, overnight, Goldman Sachs upgraded their fourth quarter forecast for Brent crude to $90 a barrel. It was $80 a barrel because right now, this morning, even though you're seeing some carrots in the likes of Axios, maybe there's potential for Strait of Hormuz opening, at the moment, it's not. It's still closed.
Hey, that's a real change. Not the 80 to 90. The change from when the war started. Goldman were looking for something $30 lower for the fourth quarter, and now you're looking at 90. That's the reality of high for longer. And you see that, I think, in longer dated prices in the oil curve as well. Bram, I know you're in the same place as me, focused on that. Just not the front month of the futures curve, but the later months making new highs in the last week.
Yeah, $86.60 in Brent crude for the December contract. This is the key point. What is the longer-term trajectory for oil prices? Halima Croft of RBC had a great point also, saying one concern in physical commodity markets is that prices in the near term are not high enough to cause demand destruction. So you're losing that kind of cyclical response to the lack of supply that would normally damper some of the lack that we're going to be seeing later this year.
Futures right now negative by 0.1% on the S&P 500. Another encouraging story from Axios, shrugged off pretty quickly. Axios seems to be the carrot every Monday morning, and then some Iranian news agency becomes the stick later on.
Yeah, and Mohammed Ghalibaf over on Twitter was talking about the supply cards and demand cards. This caught my attention because basically it was a threat. Said the Strait of Hormuz is partly played right now, but BEM, Bab el-Mandeb Strait, unplayed. Pipelines, unplayed. Basically saying the key point of our leverage is the Strait of Hormuz, but we have other cards we could throw down.
We've got a big 60 minutes coming up. We'll catch up with Calvasina of RBC with stocks facing a pivotal week ahead. Norman Roule of CSIS. Some reports Iran is coming to the table. And Sonal Desai Franklin Templeton as Kevin Warsh clears a major hurdle to be named the next Fed chair. We begin this hour with stocks holding near record highs ahead of a critical week on Wall Street. Calvasina of RBC writing the US is a global safety trade in the context of the war and seems likely to continue benefiting as long as concerns about the war's duration remain elevated. Laurie joins us now for more. Laurie, good morning.
Good morning.
This is an important question. How war-dependent is this tech rally?
So, what we've said is that once the clouds clear, if and when they do, we wouldn't be surprised to see Europe make a move, right? That seems more like the recovery trade if the U.S. is the safety trade. However, I did a survey of my analysts in early April. So we did it after the ceasefire essentially started, a few days after that, conducted it for about a week and a half. And what we found was that my European equity analysts don't see a lot of value in their own market. And it's something that we've sensed, frankly, talking with European investors as long back as December of last year. And it's just this idea that you've had this nice run there. So I do sort of question how long a rebound trade could last. And what we said at the end of the day, if you look at it from the growth versus value sleeve, and growth value in the U.S. tends to mimic U.S. versus non-U.S., what we have seen is that the earnings story is simply there for the AI trade, for the Mag 7, for the growth trade. And whatever residual damage we have coming out of this conflict in Iran, even if we dial down the geopolitical hostilities, get the Strait opened, when we hear the energy community talk about how long it's going to take to rebuild things, all the damage that's going to be done, I don't really see that hitting the earnings of the AI and the tech trade that much. I do see it hitting things like materials. I see it hitting things like industrials. I see it hitting things like consumer discretionary and staples. That is the broadening trade, right? So I see that headwind, even if we dial down the hostilities, there for quite some time for that part of the market.
Are you suggesting the exuberance in chips right now is justified? It's rational?
Look, I try to be the calm voice of reason at both tops and bottoms. And, we certainly look at semis revisions. I've talked about this a lot in meetings. They are at peak-like levels. That always makes me nervous. I tend to be a little bit more of a contrarian by nature, but I have to admit that when I go back and look at the history of semis upward revisions, they can stay stuck at elevated levels for quite some time. So I'm watching that chart very closely to see if we get a hint of deterioration, and we're just not really seeing it right now.
What do you need to see when it comes to earnings, given the fact that we're going to get the gut check from some of these big tech companies to continue with this positive, safe trade in a way for the U.S. tech companies?
So one of the things that I've noticed on the data, and Bloomberg Intelligence does a great job of tracking the Mag 7 versus the rest of the market. We highlight this data all the time in our meetings, but if you look at 2027 earnings expectations, you're actually seeing a little bit of acceleration in the growth rate for the Mag 7 versus 2026. And that's something that's just popped up over the last, I would say, month or two in the data. If you look at the rest of the market, it's still showing, some strength, but we're just really not seeing the rest of the market able to overtake that Mag 7 cohort. And so we're actually seeing the Mag 7 advantage versus the rest of the market expand in 2027. So we're looking at the 2026 numbers, obviously. It is probably a little too early to have a real handle on 2027, but at least what we're seeing in terms of the data so far, it is still really pushing that tech Mag 7 secular growth story and showing some strength there. And I think that is ultimately what's buoying the market.
Your colleague had a great note, Halima Croft, over at RBC, your company, talking about this sort of reaction function in markets that usually when there is some sort of shortage in an asset, you see prices go up, and that some of the forward messaging coming from the administration has suppressed where forward prices otherwise would be. So you don't have that kind of correctional mechanism. Are you getting more concerned that there is going to be an inflationary ramification from this that could curtail some of this enthusiasm? Because there's discussion about fiscal and because the strength hasn't enabled really that demand destruction.
So when we think about inflation and we think about how we model out earnings, what we do see is that inflation can often goose your revenue number. And I know that sounds a little bit perverse, but that's what we've seen historically in the modeling. Where inflation is really a problem, if you're looking at sort of market levels and that kind of thing, is on the PE multiple. And so we do our 12-month forward target. We do a monthly update on that. We have seen our valuation and earnings model. We've input some new assumptions that are trying to bring in kind of a more onerous inflation environment. And it's taken some of the heat out of that model, but I'm still coming up with 77.59 if I use consensus earnings, haircut them by 5%, and then I put in for my market multiple a 3.3% inflation number for the first quarter of next year, 4.5 10-year yields, and no cuts from the Fed. And, and that model was signaling well over 8,000 before, so it's a hot model, but I can still get there with the math if the earnings hold up, even if I pull the multiple down.
Laura, you noted that one company said, absent the uncertainty in economic conditions related to the Iran conflict, we would have raised our full-year guidance.
Yeah.
Convenient excuse, the Iran conflict, for some companies?
So, I know that's come up a little bit on some of the software companies. And, sort of my take on that is whenever we have sort of troubled industries, they will often sort of blame the macro. So I think that was one discussion we were having with people last week. I did notice a number of companies, and look, we didn't have nearly as many as we're having this week, but we had a lot this week. We did the best we could to sort of read through everything. And we found a number of companies also maintaining guidance. And I think what we have happening here, right, is we've got this really stiff headwind from the Middle East situation. It could continue to get stiffer, but because of hedges, because of inventories, because things have not really hit yet, right? Companies still are sort of selling this message that they can manage through, right? That may end at some point, but there are buffers in place. At the same time, you've also got these really strong tailwinds in some respects running into these headwinds. And so far, the tailwinds are ending up being a little bit stronger than the headwinds. That balance may change. But right now, it feels like the market is acting pretty rationally.
A final question for someone who's maybe taken 12 months off and taken a long vacation. Good for you, if you've done that, by the way. And you had to frame for them what's happened in this equity market. Would you say one or two? One, we've rallied aggressively off a low from only 2 or 3 weeks ago. Or two, we've done nothing since October. What would you tell them?
I think that we have chopped around, to be honest. I mean, I think that we have broken out to new highs in the S&P this year, and the week that was really getting started, I was on the road seeing clients, and they were just taken aback. That was just sort of a state of disbelief. I wouldn't say it was bearish, but I do think there was a sense of confusion, right? And we talked a lot about these U.S., non-U.S. issues, but I think the reality is that the market is actually acting pretty maturely, is acting pretty healthily. I think last time I came on the show, I think I said something like, take a deep breath. And I've been sort of saying that message, take it one day at a time. And I will say, when I've talked to some of my faster money clients, kind of the hedge fund crowd, I was impressed back during March that they really weren't doing a lot, whereas maybe 10 years ago in my career, they would have been trading the heck out of the short-term downside, but they had their hedges on. They were waiting to see what happened. The long-onlys weren't doing much. That's a very different maturity level than what I saw 10 years ago in my job.
You fancy that 12-month vacation?
I would love it.
Right. Laurie Calvasina of RBC. Laurie, thank you. You want a year off?
I mean, look, I think that, please, petition away, because I'm right there behind you. I love that people are telling us, take a breath, take a deep breath. You've got Jim Zelter, take a walk.
Take a walk, touch grass.
Essentially, touch grass. So, I think that the world, the stars are aligning, John. I think that
I'll give you a great example of the fatigue setting in. For the last 2 months, we've talked about Monday morning starting on Sunday evenings. That stopped this weekend. I didn't sense a buzz of people anticipating the open Sunday evening at all in quite the same way. There's a real fatigue that's clicked in with this story. This story is still important, but there's a real fatigue that's clicked in this market.
Not only that, I think that absolutely you're correct, but to add to that, to build on it, not only did you see oil prices tick up in futures, but so did stock futures, right? So did equity futures around the world. So people seem to be shrugging it off because ultimately they weren't trading in the same kind of tight correlation.
Crude this morning up 2%, just short of 108 on Brent crude. WTI at 96.40 with an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, good morning, John. A 31-year-old man will be arraigned today over Saturday night's shooting at the White House Correspondents' Dinner. The acting attorney general says the suspect was probably targeting Trump administration officials, but his exact motive is not yet clear. Iran is offering the U.S. a new proposal for reopening the Strait of Hormuz and ending the war. Axios is reporting the offer postpones nuclear negotiations to a later stage. President Trump is expected to hold a meeting with top security and foreign policy officials later today. Senator Tom Tillis is ready to advance Kevin Warsh's nomination as the next Federal Reserve Chair. Tillis says the Justice Department's decision to end a criminal investigation into current Chair Jerome Powell removes a threat to the central bank's independence. That is your Bloomberg Brief. John.
Vonnie, thank you very much. Opening the door for confirmation, but have we opened the door for Fed Chair Jay Powell to go to the exit? And that's a slightly different question.
Well, that's what I want to know. So obviously we're going to have a new Fed chair likely May 15th. Does this mean Jay Powell views this now as a time to step aside, no longer needs his governor's seat? Maybe we'll find out this week.
We'll have that conversation later this hour. Up next on the program, an attempted shooting in Washington, D.C.
Mr. President, do you know if you were the target of the gunman?
I don't know. It sounded to me, I read a manifesto. He's radicalized. We live in a crazy world.
Up next, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Equity futures pulling back from all-time highs. We're down just 0.1% on the S&P 500 following 4 consecutive weekly gains on the S&P. On the Nasdaq, up by 0.1% following a record 18-day winning streak for the semis going into a major reporting week on Wednesday. Some of the big spenders, the big customers of those chip companies.
And that's the key question to me, is how much are we going to see some of the large tech players continue to reaffirm acceleration in their plans to keep spending, just propping up that semi-trade that much more.
Let's get to crude. 5-day winning streak could become 6. Brent crude this morning just short of 108, up by 2% this morning. WTI up by 2 percentage points as well. Starting to see the tension rebuild. Not just at the front end of the yield curve, or rather the crude curve, but further out as well. You can see which market I'm used to talking about. Further out as well, to the latter summer months and deeper into the year, into 4Q.
This feels like a stalemate, and a lot of people are gaming out how much it could really take to reopen the Strait of Hormuz and then get production restarted, which is the reason why you see Brent trading at the highest levels in the December contract going back to the start of this conflict.
I want to turn to the bond market briefly. Yields a little bit higher by a single basis point at the front end of the curve. The 2-year this morning at around 3.80. Under surveillance this morning, an attempted shooting in Washington, D.C.
Mr. President, do you know if you were the target of the gunman?
I don't know. It sounded to me, I read a manifesto. He's radicalized. We started to realize maybe it was a bad problem. I was walking out. It was about halfway there, and they said, please go down to the floor. Please go down to the floor. So I dropped to the floor. I wasn't worried. I understand life. We live in a crazy world.
So here's the latest this morning. The suspect accused of opening fire outside the White House Correspondents' Dinner expected to be charged in federal court later on today. Bloomberg's Tyler Kendall joins us now for the latest from Washington. Good morning, Tyler.
Hey, John, good morning. Well, the suspect is facing 2 federal charges, though the U.S. Attorney for D.C., Jeanine Pirro, says she expects more to be added as the investigation unfolds. It's right now in its beginning stages, though preliminary evidence does suggest that the suspect, Cole Allen Thomas, was targeting administration officials. He was carrying knives, a shotgun, and a handgun. Manifesto reviewed by Bloomberg News shows he wrote that President Trump was a, quote, traitor. Now, the acting U.S. Attorney General for D.C., Todd Blanche, has suggested that Allen is not cooperating with investigators, though they've already been able to piece together some of his movements ahead of the planned attack, including that he traveled cross-country by train from California to Chicago to Washington before he checked into the event space, the Washington Hilton, several days ahead of time. There are a lot of questions here that still need to be answered when it comes to what security protocols are going to look like going forward, though the Secret Service has defended its actions. And, John, we can say President Trump did confirm that one Secret Service agent was shot, though he says that he has been fully recovered and that he was protected because he was wearing a bulletproof vest.
Tyler Kendall with the latest. Tyler, good to see you safe and well as well. Tyler will keep tracking that story for us throughout this morning. Also tracking the latest developments between Iran and the United States. The latest from Axios this morning. Iran gave the US a new proposal for reaching a deal on reopening the Strait of Hormuz and ending the war, with nuclear negotiations postponed for a later stage. This is the view from Norman Roule of CSIS this morning, writing the following. The most likely course over the coming week is continuation of the current blockade and indirect diplomacy. A narrow maritime arrangement remains possible. Norm joins us now for more. Norm, a warm welcome to the programme. That last line, a narrow maritime arrangement remains possible. Norman, what do you mean by that, and what kind of arrangement might we see?
Good morning. And first, it's good to see Annmarie here, and I'm glad that she is safe, and obviously the president and the other attendees. It's possible that some sort of arrangement to allow a limited amount of humanitarian goods could go through, but that itself remains unlikely. And here's why. In essence, the United States and Iran each see the Strait of Hormuz as not only the focal point for this, but their main pressure point over the other. We're now in a 3-clock contest. The United States sees the control over the Strait of Hormuz as its sole opportunity to squeeze the Iranian economy. And that's a real pressure point. Inflation is rising in Iran, and it's enduring real economic pain as its oil industry shuts down. But the Iranians know the war power situation is coming to a head this Friday. It's only a political issue in the near term for the president, but it's a real one. And of course, economic pressure in the world is coming forward. So you've got a situation where each side is in this viewpoint that the Strait of Hormuz is the central pressure point point for each other, but there's just a narrow deal that is out there. But we're in essence negotiating on whether we should be negotiating, and the Iranians see the Strait of Hormuz as their chance to get out of jail economically.
Norm, nice to see you too this morning. Could this maritime arrangement mean, or is accepted by the United States, if Iran continues to have a toll and continue to control it, even if ships can pass through?
That's unlikely, and let me explain why. The United States sees that the only way that it's been able to bring Iran to the table is for meaningful talks has been through economic pressure and military pressure. Now, if the Strait of Hormuz is open, well, the first thing that's going to happen is, what is the purpose of the entire U.S. military presence in the region? Are we going to maintain 3 aircraft carriers in the region if there was no blockade? That's unlikely. So if the military pressure is removed, if the economic pressure is removed, what do you think the chances are that the Iranians are going to come to the table with any serious negotiating position? Now, they'll come to the table, and they have done this for years with multiple administrations, but as history has shown with the Iranians, they come to the table to talk. That doesn't mean they come to the table to talk about anything seriously, and the Trump administration, in fairness, knows this history quite well.
Mohammed Ghalibaf on Twitter was talking about supply cards that the regime could still use. The Bab el-Mandeb Strait, he says, is unplayed, as well as pipelines. Is this just a threat, or do you think that we could see real escalation?
Well, it's probably more accurate to say someone typing on Twitter in the name of Mohammed Ghalibaf is stating this. The Iranians do have the capability of resuming hostilities, but bellicose rhetoric has long been a mainstay of Iran's public diplomacy. It's a possibility, but at the same time, we have 3 aircraft carrier task forces in the region, which have an enormous military capacity to produce quite a significant amount of destruction against Iran's military and civilian infrastructure.
Norm, I'm curious about the economic blockade that the U.S. is engaging with and how much leverage it's giving the United States versus Iran, given the fact that it is starving them of much-needed dollars and there's discussion about dissent among the ranks who aren't getting paid. Do you have a sense of how long Iran has to hold out versus the U.S. and its allies?
No, and that information is not going to be known outside of probably Iran and intelligence services. Now, Iran is going to hold that data very close. It doesn't want the world to see that the pain that is being imposed by the economic blockade, nor the military damage, is how serious that is to actually being felt, because it's going to want to appear to be robust, defiant. Not much is happening, but the pain is genuine, and it's likely that the administration has a good idea of this, and for this reason is willing to hold off on negotiations. So you've got each side understanding the pain of the other. It's just that the Iranians can see the U.S. political pain because our system is open. For the United States, it's going to have to assess this through other means.
Norm, always good to see you to get your reflections on the current state of things. Thank you, sir. Norman Roule there of CSIS. Crude this morning on Brent just short of 108. Without extreme inventory draws, this number would probably be a lot higher. And that's the view of Goldman Sachs this morning as well. Extreme inventory draws are unsustainable. Even sharper demand losses could be required if the supply shock persists for even longer. And
a lot of people have been saying this with something like 1 million barrels that are now withdrawn from the overall market as a result of this closure. And you have the trajectory right now, as we were hearing about late last week from the folks over at Goldman Sachs. The trajectory is for record low inventories. This gives a very low cushion, and it's part of the reason why maybe you haven't seen more of a disruption at the front of the end of the oil curve so far.
And it's why you're seeing an Axios story about maybe you can have some sort of maritime deal when it comes to Strait of Hormuz, but not actually a nuclear deal. Gasoline this morning, $4.11. Huge problem for the White House heading into the midterms.
Up next on the programme, we'll catch up with Stephen Schork of the Schork Group. On crude, still rising, plus Yahira has your morning movers. Qualcomm getting a boost from a potential partnership with OpenAI. Live from New York City this morning. Good morning. You're watching Bloomberg TV. 4 weeks of gains on the S&P 500. Believe it or not, the longest weekly winning streak going back to October 2024. Equity futures this morning pulling back from all-time highs, down just 0.1% on the Nasdaq. Big week for the Nasdaq, and by 0.1% this morning, heading into a lot of earnings later this week. 4 names accounting for about a quarter of the index coming up on Wednesday. Before we get to all of that, we've got to talk about the run of chip stocks. 18 days of gains for chips, up another 10% just last week alone. Nvidia this month, and April's not finished yet. Nvidia's up 20% almost this month. That's more than $800 billion of market cap added to that single name.
Hitting a record high after really not neglecting to do so over the past number of months, despite some of the record highs in the overall indexes. That chip run, the 18 straight days, it is up 39% in that period of time.
Crazy.
Do you see the affirmation of that run when you see the capital expenditure plans of some of these big tech players? Does that give it more wind, or is the bar now so high? It's sort of buy the rumor, sell the news. And I think that's going to be one of the more interesting aspects of this week.
40% run for chip stocks. Just amazing. With this taking place in the commodity market, that's what's insulating the equity market stateside. Looking at crude this morning, Brent up every single day last week. Over that 5-day period, higher by some 16%, and up again this morning by 2 to around 108. And as we keep talking about this, it's not just the front end of the futures curve. It's the longer end of the curve as well, starting to price in higher for longer.
There is a feeling of boiling the frog here, that the longer this goes on, the more we could hit some sort of key thresholds where it gets a lot harder to bring oil back online. And frankly, the shortages are becoming very real. And that is what a lot of strategists are looking at. Citi's Stuart Kaiser came out and said, ultimately, we could hit that tipping point where suddenly it becomes this concern of the stock market. Right now, it isn't. But it very well could be, and we might be getting close.
Well, this Goldman story is talking about what prices will be like in the fourth quarter if we have extreme inventory draws, which if the Strait of Hormuz continues to be shut for a prolonged period of time, we will have those draws. It's about $30 higher now for their fourth quarter adjustment than it was before the conflict began.
It was around 60 for the fourth quarter, and now it's an average of 90. And that's up from a previous forecast of 80. These are big revisions that keep clicking in. In the bond market, 2s, 10s and 30s, we can spend some time on the future of the Federal Reserve a little bit later this morning. Let's just sit on the 2-year. Yields basically unchanged, up maybe a single basis point to around 380, 378, 66 this morning. As we count you down to the up and about 3 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Chips could be up again today. Given this move here in Qualcomm shares are up 10.5% in the pre-market on a report that it could be working with OpenAI on smartphones, something we know OpenAI has been interested in ever since it acquired Apple legend Jony Ive's startup last year. But even though this is just a report and still early days, it's enough to get investors excited about the potential of an OpenAI smartphone. And that same report is pushing Apple shares lower, down 1.5% on the concern that OpenAI can push into the hardware market and become a direct challenger to Apple, where consumers might opt for a smartphone built around AI from the ground up. And we end on the car rental company Avis. Those shares down 2.5% in the pre-market after a 70% plunge over the last 3 sessions. But remember, this stock had run up some 600% in just a matter of weeks, that largely due to a short squeeze. But we are seeing a bit of an unwind here, but it's a move very reminiscent of the meme stock days. John?
Yahira, thank you. What a wild ride. More from Yahira in the next hour. On our radar this morning, Iran signaling it may be willing to accept an interim deal with the US. Axios reporting Tehran will reopen the Strait of Hormuz if Washington lifts its naval blockade and postpones nuclear talks. Elsewhere, the president recounting his evacuation from the White House Correspondents' Dinner, telling 60 Minutes his policy decisions may put him in greater danger.
This appears to be the third attempted assassination on your life. Why do you think so many people may be trying to kill you?
I've done quite a bit of research into the word assassination, and they go after consequential presidents.
Your policies are also controversial. Is that part of it?
Well, I don't think that way. I don't think in terms of what they are. I just think of what they are for the country.
The FBI and Secret Service investigating a potential motive for the shooting. And finally, Republican Senator Tom Tillis is ready to advance Kevin Warsh's Fed chair nomination. Tillis saying the DOJ's decision to end its criminal investigation into current Fed chair Jay Powell eased his concerns over Fed independence, which raises a question not about Kevin Warsh's future, but now about Chairman Jay Powell's.
If you were thinking that this was going to be a boring Fed meeting on Wednesday when Chair Powell gets to the podium, I can say it will not be. And this will be the ultimate question. What is your plan? Do you plan to stay on? What is your threshold? I know he will have written answers to this, but every journalist in there does not care what his view of forward interest rates really looks like. They care about his future and what the composition is going to look like. And ultimately, he will have to respond in some capacity.
There was one line in his news conference that's going to be repeated into Wednesday with transparency and finality. So when we heard from the US District Attorney Jeanine Pirro, she said the following: would not hesitate to restart a criminal investigation should the facts warrant doing so. Have we wrapped this up with transparency and finality?
Well, the way Senator Tillis talked about it, he said that he's been given assurances by the DOJ that they are stopping when it comes to the probe. But the Fed Inspector General is pursuing a separate probe when it comes to the cost overruns and seeing if there was anything egregious when it comes to the building renovation. But he feels like he has enough from the DOJ to pursue a yes vote on Wednesday at the Senate Banking Committee to make sure Kevin Warsh goes through. You know, I tried to talk to Jeanine Pirro about this at the White House Correspondents' Dinner before all the chaos with Tyler Kendall. She just wanted to talk about fashion. Then when I said, well, actually, I came over here to talk to you about the DOJ, what's going on with Kevin Warsh and Jay Powell, she goes, oh, do you want to know about that? And then walked away.
That meets the bar for Senator Tillis. The question I'm asking is whether that meets the bar for Fed Chair Jay Powell, who could remain on the board for the time being.
Is he trying to keep leverage to get it completely dismissed in some capacity where he isn't going to have liability after the fact? And does he get sort of preserve his immunity by staying on the board? All really reasonable questions, all should be asked. And frankly, do we get the transparency and directive at this Fed meeting about what exactly is going to happen?
Chairman Powell in the hot seat. Looking forward to that on Wednesday afternoon. Let's turn back to the commodity market. Crude rising for 5 consecutive days with the US-Iran peace talks at a standstill. Stephen Schork of the Schork Group writing the smart money has already exited and the crowd hasn't noticed. Producers are locking in $90 plus prices. Barrels are already sold into 26. Stephen joins us now for more. Stephen, welcome to the programme. Let's pick up on that line. The smart money has already exited and the crowd hasn't noticed. Just build on that for us, please.
Yeah, absolutely. So since the start of the conflict 8 weeks ago, we saw a rise in open interest, a rise in trading and positions, long positions being held by hedge funds and proprietary or trading desks, our institutional investors. But net 8 weeks into it, the hedge funds are only net long now 45,000 contracts where we were before the conflict. Given that we've had a 50% rise in oil prices, we're seeing a very de minimis reaction now by the hedge funds. So it looks like the hedge funds did participate in this. They did ride this up, and now they've moved to the sidelines. The same with the other side of it, the other reporters, large speculators. Their position is effectively zero since the start of this. That they came into this at a certain length, and they're no longer today than they were 2 months ago at the start of the conflict. So that smart money, being the large speculators, have moved to the sidelines right now. So they certainly participated, but they're no longer participating at this time. So they've moved to the sidelines, keeping their powder dry, waiting for the next headline to make their next move in the market. But clearly, they're out of the market, out of the run at this point.
Stephen, have we moved away just slightly from the headline roulette that we had been experiencing for a number of weeks, where suddenly this feels like a stalemate? This feels like a higher for longer situation where there is destruction in terms of just the facilities as well as potentially in demand coming from over in Asia. Are we reaching that tipping point?
Absolutely. Now, the difference here than it was 2 months ago. 2 months ago, end of February, March, when this began, global demand for oil on the calendar is at its weakest point. This is when the refineries are shutting down. They're buying fewer barrels. They're getting ready for the summer demand season. Well, it's late April. A couple more weeks, we'll be at Memorial Day. Peak demand season for gasoline, for diesel, for jet fuel. So that hammer is about to hit the market. So perhaps on the speculator side, they're sitting there waiting for this hammer to hit. But we are 3 to 4 weeks before we hit the peak demand season. And this is what likely has been keeping a cap on prices, just a lack of demand, both from demand destruction because of higher prices, but also the normal seasonal demand destruction that we see in February, March, and early April. But that's about to change. So absolutely that we're looking at a market now higher for longer, certainly through the rest of this summer into the third quarter is the play at this point.
And Stephen, to reiterate that point, I mean, John and I have been talking about the forward curve in oil futures and how it does seem to be increasing the cost over into December with $90 a Brent almost at one point. You're talking about how producers are locking in $90+ a barrel for the remainder of this year. How long could you see that type of price level persisting?
Oh, absolutely. Well, that is one of the caps. That's one of the positives in the market where producers, when we look at the CFTC data, have sold in WTI approximately 200 million barrels of oil. Now, they're not going to produce that, but their hedge desks are well prepared for this. So there is going to be a significant amount of oil production coming to the market to offset those hedges. So certainly when we're starting to look at the back end of the curve, this is kind of the signals that we are getting now when we look at the spread relationships in that term structure of forward prices. Oil prices now going into the fourth quarter, which again, now we get to the point where we're coming out of the peak season into a lull in demand. But certainly we're looking at now $90 a barrel, now becoming more of the norm as we look forward through the end of this year.
Stephen, you say Gulf Coast products are running on fumes heading into Memorial Day. How much higher could we see U.S. gasoline?
Yeah, absolutely. So that is the real concern. And it's a really interesting phenomenon because now we have, of course, the Gulf Coast refinery epicenter, which the majority of that production gets put on pipelines that get sent up into New York Harbor, the Colonial Pipeline. And we also have domestic vessels that do transport barges into New York Harbor. But we've waived the Jones Act. So now you have foreign flag vessels that are allowed to load product in Houston and move it into the East Coast. And that has accelerated because the access of that ability to move oil out of the Gulf Coast has accelerated a significant downturn in inventories in that region at the most important part of the year. So how high can we go? I believe on the previous segment, you quoted gasoline prices, national average around $4.11. Well, 3 years ago, we were at over $5 a gallon at this point. We're not going there yet at current pricing. The market has priced it in, but certainly if we start ticking higher, about every $1 higher of crude oil translates into about 1.9 to 2 cents at the pump for the consumer. So right now we are certainly pushing up to the levels of 411. We calculated possibly 2 months ago, we calculated 425 national average coming into the summer. That was holding the status quo. So at this point, the answer to that is if oil prices hold in this range, mid-90s to 105, 425, 440, 450 is likely the highs we are looking at. So it all depends on where oil prices are going at this point.
Stephen, do you think this administration could go back to the drawing board and potentially make sure there's an export ban heading into the midterm elections?
Yeah, I've started to hear that now, and it's a very scary proposition at this point. To look at in an export ban. Now, if it's an export ban on crude oil, well, why are we doing that? Because a lot of the crude oil we produce, we don't even consume. We can't maximize not at our refineries. So we want to keep that trade open because what we do is we produce high quality oil, sell it at a premium, and then replace it for our refineries with a lower quality, lower priced oil. From a trade balance standpoint, that's a no-brainer. But I've heard rumblings now about an export ban on products. This is a political event economically, from a market standpoint, from a trading standpoint. It is just a doom loop that will ultimately push prices even ultimately higher. But from a political standpoint, it doesn't matter if you're on the right, or you're on the left. Stupidity knows no political bounds. So we saw some pretty dodgy moves in the past administration. I wouldn't put it past this administration to do something because why would they do that? Politically, they can say, aha, you see, we exported product, we put the ban on these products, but prices are still going higher. So who are you going to blame after that? It's going to be those greedy oil companies you're going to blame, not the whole market mechanism that you're playing around with. So it is a possibility. You can't rule anything out in this market these days.
And that can get messy quickly. Stephen, thank you, sir. Stephen Schork there of the Schork Group. Crude on a 5-day winning streak. We can make it day 6. We've got gains today, rising for a 6th consecutive day. Brent crude, 106.81, up by more than 1% this morning. With an update on stories elsewhere this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump saying Saturday night's shooting justifies the White House's need for a new ballroom. Last month, a federal judge ordered construction stopped until the president gets approval from Congress. The DOJ filed for the lawsuit to be dismissed following the shooting. DeepSeek is pitching aggressively low prices in an attempt to intensify competition across the Chinese AI market. The company is offering a 75% discount to developers using its new flagship model, V4 Pro. A group of budget airlines, including Frontier and Avelo, is seeking $2.5 billion in government assistance. The Wall Street Journal reporting the airlines would offer warrants that could convert into equity stakes. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. I'm next on the programme confirming Kevin and Warsh.
I am prepared to move on with the confirmation of Mr. Warsh. I think he's going to be a great Fed chair. So this will allow Mr. Warsh to move on with his confirmation on time.
Will it allow Chairman Powell to move on? Sonal Desai Franklin Templeton joins us next. Equities on the brink of turning positive on the session so far, just about unchanged on the S&P 500. Positive on the Nasdaq, up another 0.15%. Under surveillance this morning, confirming Kevin Warsh.
I am prepared to move on with the confirmation of Mr. Warsh. I think he's going to be a great Fed chair. So this will allow Mr. Warsh to move on with his confirmation on time. And then Mr. Powell will have to make his own decisions at some point in the future about when and if he leaves the board before the end of his 2028 term expiration.
So here's the latest this morning. Kevin Warsh clearing a major hurdle to become the next Fed chair after the DOJ dropped its probe into the central bank. The Senate Banking Committee set to vote on Wednesday. Sonal Desai Franklin Templeton joins us now for more. Sonal, good morning.
Good morning.
We can get into the future of the Federal Reserve under Kevin Warsh in just a moment. I just want to get through the Federal Reserve current chair, Chairman Powell, and what's going to happen to him. So some key dates. So May 25th is when his term finishes as Fed chair. 2028, he can stay on the board as a Fed governor. Which date do you think he's going to choose here?
You know, number one, I don't know. It really depends on what he wants to do. But number two, I'm not sure it matters. It really doesn't matter. This notion that somehow the current Fed chair is the only thing standing behind complete loss of credibility of the Fed and whatever else lies ahead, I think that's misguided. I think that the institution is relatively strong and enormously dovish. So I don't think that it's just Jay Powell who stands between.
Enormously dovish. Does that change with the change of one man then?
No, I don't. I actually, you know, so again, this entire focus on loss of credibility for the Fed seems to really focus on the idea that this is what is going to cause the Fed to lose credibility. And I would argue the Fed actually did it to itself when it monetized fiscal deficits of close to 25% of GDP over a 2-year period. I'll just repeat, 2021, 2022. So everything since then is the Fed trying to regain credibility. And I don't happen to think that Kevin Warsh is going to change that dynamic.
Well, there is this question about whether he is going to be dovish, whether he's going to cut rates even in the face of inflation that potentially is stickier for longer as a result of what's going on with oil prices. Do you agree with that? I mean, do you think that this is ultimately someone who, even though he has been hawkish for most of his career, will skew dovish in the face of political pressure?
So I would say if he does skew dovish, I would be surprised, because the biggest thing he's talked about is the idea of taking monetary policy back to its orthodox roots, which means you don't buy long-end treasury. If the Fed's overall balance sheet had expanded at the average pace of nominal GDP, we would be looking at a balance sheet of around 1.5 to 1.6 trillion today, as opposed to closer to, 8 trillion? So we're looking at somebody who's taking the Fed back to its roots. And I think that's, on balance, what is more important. Will he cut rates? I think if the situation demands it. Right now, I'm not calling for more Fed rate cuts this year, based on fundamentals.
So where does this leave you in terms of your market expectation? Because listening to that, I could make two ideas. One, if he really is going to be hawkish potentially based on what he's done in the past, or at least trying to reframe the Fed around its old framework, well, then 2% inflation remains 2% inflation. I would buy long bonds because ultimately that would be a very different scenario than, say, a dovish Fed. If this is someone who's not going to be buying long-term bonds, on the other hand, that's potentially a pressure. Where do you line up on that?
So right now I'm not buying long bonds here because I don't think long bonds are yet fully pricing what I think is going to happen. And you've got to look into a multi-year period here. And I hear where I disagree with Kevin Warsh is his idea that productivity, stronger productivity growth is necessarily going to lead to a lower, call it a neutral nominal Fed funds rate. I don't actually agree because that Fed funds rate is a combination of inflation and long-term productivity. So the idea that the disinflation from productivity is going to be enough to make up for the increase in productivity, I'm not sure that works. I'm not sure that the round of productivity increases we're going to get this time will necessarily be disinflationary. So what I mean by this is 2% productivity growth, 2% inflation, 4% Fed funds neutral rate. I'm not sure we're at 2% inflation, and I actually think we're going to get higher than 2% productivity growth. So if anything, I think neutral Fed funds is higher.
Right, but this Fed has shown it's willing to cut interest rates even without 2% inflation.
Oh, absolutely.
So wouldn't he be able to make a case to this, the FOMC?
He could, but not right now, and I don't think not this year. Essentially, I don't see oil prices, and this is a headline issue, I totally get that, headline issue. I don't see oil prices coming down. We estimate around 25, 35 basis points of inflation for each 10% increase in oil prices. You easily, comfortably get closer to 4. Now, I get it, they're supposed to see through it, but after the period we just came through in 2022, 2021, I doubt that this Fed is going to be cutting into that.
You said something that actually you could argue that the neutral rate's higher than where it is currently.
Yeah.
Is this a Federal Reserve under Kevin Warsh that you could see hiking as its next move?
Only if we thought inflation was significantly higher. I see this Fed frozen next year. Could we see Fed funds higher? It's possible. It's not my baseline right now, but I'm certainly not anticipating additional cuts from 350.
Let's go there. What would make it your baseline?
Sorry?
What is significantly higher inflation? What is that? Going from 3 to 4, 4 to 5? What is that?
So to me, it's more 4 to 5. 3 to 4, I believe they probably look through. You start going to 4 to 5, you're looking at second round.
Do you think this labour market's strong enough, tight enough to generate that kind of inflation?
You know, the labour market is pretty balanced, and I think it's improving. It's not deteriorating here. The data which has come out is all hawkish. It's a very difficult situation for anybody to come in and start cutting.
Sonal, great to see you, as always. Sonal Desai there of Franklin Templeton. This labour market, the data we've seen more recently, has been pretty decent in the US economy. The only outlier seems to be the confidence figures, the sentiment numbers. I really struggle with the sentiment figures. The idea that UMich consumer sentiment has never been lower in the history of that survey going back to the late 70s. Think about everything that's happened in between over the last 40, 50 years.
I can't imagine that people felt much better in 2008, maybe in October, after Lehman Brothers had fallen, and the real question about the mortgage overhang. Look, a lot of people have disregarded the sentiment figures as something that they put into their models and then reject when they get other data that seems to contradict it. And people are looking at things like Neil Richardson saying, which is that actually you are seeing hiring pick up, to Sonal's point. And those are the metrics that people are really going to keep a closer eye on.
When it comes to the sentiment figures, it's basically become somewhat of a political poll. And that's really what it is. It's showing sentiment about politics. Do you agree with the president and his policies or not?
Youth employment picking up as well. It's good to see you. Seen some of that data?
Are you kidding?
Very
I was getting very excited. I'm like, only 4 more years. Hang in there.
You need them to get paid, right?
I need them to get paid at the other side. They're not kind of bankrolled by me.
Coming up on the programme, it's good news. We'll catch up with Russ Koesterich of Blackrock, Henrietta Treyz of Veda Partners, Jonathan Krinsky of BTIG, Collin Martin of Schwab. The second hour of Bloomberg Surveillance just around the corner.
It is going to be, I think, very tough
for the Fed to change their stance.
We do think the Fed will still get in at least one, if not two cuts by the end of this year.
The focus the next couple months will absolutely still be inflation data.
Our view is that you're going to get demand destruction in some way.
I'm increasingly worried that you're seeing pressure on the consumer.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. In the price action, your scores look like this. Unchanged following 4 weeks of gains on the S&P 500. All-time highs on the Nasdaq and up another 0.2% this morning. Going into a week full of tech earnings. Let's get to Wednesday and the week ahead. On Wednesday, we have got the likes of Amazon, Microsoft, Meta, Alphabet. Thursday, get a sneak peek of Apple and what's happening over at Apple HQ. In the meantime, you've got an 18-day winning run on semis that could become day 19, thank you Qualcomm, and a run keeps building.
And it really is predicated on the idea that spending is existential and will keep going. Do we see that 40% rally continue, given the fact that likely these tech giants are going to talk about that? Just to put into perspective how big of a week it is, $28.8 trillion of market capitalization is how much the companies that are reporting earnings this week account for in the S&P 500. Just on Wednesday alone, it's $14.3 trillion. So this really does give us a sense, A, of the resilience, and B, of just how high the bar is for these names to continue to be the safe havens.
They are the secular tailwinds guiding and driving this equity market. These are the cyclical headwinds that we'll be talking about throughout the week as well. Brent crude, WTI, Brent crude around 107. WTI around 95, and another gain this morning. Brent up every single day last week and up again this Monday morning.
What says to me is that the market is now conditioned for these Sunday night news stories that potentially a deal is on the horizon, but it's actually not. And I'm talking about what came out last night from Axios, saying that Iran, through Pakistani mediators, gave the U.S. a new proposal for reaching a deal on reopening the Strait of Hormuz and then basically putting on the back burner when it comes to the nuclear file. At the moment, that is not the case in terms of what is actually happening on the ground. The Strait of Hormuz remains shut, and that is why you're seeing firms like Goldman Sachs coming out and saying we are going to see higher for longer crude.
Speaking of doors shutting, the door is officially shut on a merger between American Airlines and United Airlines. Just getting a statement from the United Airlines CEO, Scott Kirby, just moments ago.
Yeah, he's saying this is a very personal, this is a very different kind of press release, which is first person. Over the last 2 weeks, there's been a lot of commentary about a potential merger between United and American. And to be direct, here's what happened. I approached American about exploring a combination because I thought we could do something incredible for customers together. He was confident with this combination. He was hoping to pitch the story to American, but they declined to engage and instead responded by publicly closing the door. And without a willing partner, something this big simply can't get done.
It goes on, the statement does, and we'll bring you more headlines from it. But ultimately, it raises the question, something can't get done with American, but can something get done with someone else in the sector?
And it seems like there's an open door given the fact that budget airlines have their hands out to the government looking for some sort of bailout. Can you see a wave of consolidation? Is this administration amenable to things that perhaps the previous administration was not? That really is the question. As we see other announcements for mergers, there is a huge wave of mega mergers that has been emerging in 2026. Does the airline industry enter in stage left?
What I find is interesting is this potential United America, as I was calling it. To John's point, maybe there is just consolidation elsewhere. And we had an airline analyst on talking about the fact that maybe if they want an in when it comes to JFK, they would need to look at something like a JetBlue. What I find interesting about this statement is that not only is the CEO here talking about this potential and how it's very personal, he went himself to go pitch this, but goes through the benefits of what the combination could have produced. Potentially an appetizer for maybe another airline.
I'm just eyeballing this, but 2/3, maybe close to 80% of the statement is about a rationale for further consolidation in the sector.
Yes.
Which to me, yes, closes the door on American, but leaves the door wide open to a combination with someone somewhere down the line.
Yeah, JetBlue, someone that people have talked about, right? Who are the other airlines that might be potential suitors, or that clearly this is the ambition over at United?
United this morning down by 0.5%. More on that sector a little bit later. Coming up this hour, we'll catch up with Russ Koesterich of Blackrock. Heading into a big week for tech earnings, we'll speak to Henrietta Treyz of Veda Partners on another potential plan to reopen the Strait of Hormuz, and Collin Martin of Charles Schwab as the path to Kevin Warsh's Fed nomination clears. We begin this out with stocks at record highs ahead of key tech earnings. Russ Koesterich of Blackrock writing the following: we've been increasing our equity exposure, adding back US tech, which is attractively priced relative to the broader market. Russ joins us now for more. Russ, welcome to the program. This is a question people struggle with. Is the outlook for the equity market now really better than it was before this war started?
morning, Jonathan. I don't know if it's better, but it's still resilient. The reality is we probably are going to see different drivers than we're expecting back in January and February. And as you remember, back in the beginning of the year, late 25, it was all the broadening out trade. It was about a better than trend economy, pushing up cyclicals, value, small caps. And over the last 3 months, that narrative has changed and really has gone back to a lot of what we were talking about in 23, in 24, which was a market where earnings are strong, but a lot of that strength is being driven primarily by tech and adjacent names.
Russ, the price of the story, 18 days of gains for chips could become day 19. We haven't seen runs like these since the early 2000s. Why is the price of the story still attractive?
Well, first of all, you've never seen earnings like this. I mean, you look at what's happened right now for this earnings season, tech earnings growth expect to be around 29%. Broader market, half of that. The median stock, half of that. So this is an environment, again, where the earnings are really being disproportionately driven by not just tech, but by a relatively narrow part of tech, particularly AI-related, the hyperscalers and semis. But the other thing worth noting is that, yes, we've had this run over the last 2-3 weeks, but really since last summer, tech repriced. And you look at the relative PE of technology companies, the S&P tech sector, relative to the broader market. Earlier this spring, it got down to the lowest we've seen in 5 years. So obviously some of that value has been taken up with the rally, but they did get cheap as investors abandoned the sector and the space for other themes like cyclicals.
Russ, do you think that the bar is pretty high for earnings this week, or does it almost not matter and people are going to look instead at what the forward look is for CapEx and just generally what the demand really seems to look like?
It certainly matters. And again, to be clear, this rally is predicated on the notion that this part of the market is going to outgrow everything else. So you're going to need to, one, deliver on Q1 earnings. People are going to be looking at guidance. I think the CapEx story is interesting because we've gone through sort of several reaction functions by the market. Back in 23, 24, early 25, the market applauded some of these huge CapEx numbers. Then in the back half of 25, you had some skepticism creep in. Is all the spending going to be worth it? I think we're starting to go back to a world in which people are looking at that strong CapEx as a sign of confidence. And that's something else, as you point out, investors are going to be focused on.
This is a fascinating point, Russ. So you think that the early read on Tesla tripling their CapEx budget and then getting punished in the market afterwards was an anomaly, not necessarily a trendsetter for what we can expect from the other tech giants?
I think it's a little bit of a different response with Tesla than the hyperscalers, because, again, you're talking about a different business model, and you're also talking about this broader question about AI adoption.
Russ Koesterich of Blackrock there with the latest, looking out to the equity market at all-time highs on the S&P 500 and the Nasdaq. Can you make the case things are better now than they were before the war? That's where the market is, ultimately, at all-time highs.
Well, some people would speculate that the CapEx that was not rewarded necessarily by the market wasn't even rewarded in the stocks that would benefit the most from it because people were moving on from the tech story and were concerned about it. And suddenly now they're coming back around as they look for other things that they can do that isn't dependent on headline roulette. And so suddenly people feel better. They look at the re-rating and they look at the fact that earnings have continued to gain. So from that perspective, yes. I do wonder whether Russ's last point there was correct, and I think it's a really interesting one, which is that if we see big CapEx spending, that it will actually be rewarded in a sign of confidence once again by the markets, not akin to what we saw from Tesla. And that, I think, is a really interesting
Would you
point.
like to play headline roulette? Is that the game you'd like to play? We play it every Monday morning, so why not?
Not particularly, but sure, go ahead.
Usually going into the weekend, talks are happening, and then over the weekend, talks don't happen. And then you open up on Monday morning, and there's usually a report, I'm sorry, Axos, but it's usually from you, about how close we are to a potential deal. So this is the latest from that publication. Iran gave the US a new proposal for reaching a deal on the reopening of the Strait of Hormuz and ending the war, with nuclear negotiations postponed for a later stage. That last piece of it is the most important piece of it.
Right, because the nuclear talks would obviously take months, maybe even years, when you look at history. How long did the JCPOA take to come together? How long did the Biden administration speak to the Iranians, their entire administration? And then Trump, too, spent a year talking to them about nuclear, and nothing ended up happening on that point, which is why we are here today. The key, though, also to that is that obviously Iran knows their leverage, and it's the Strait of Hormuz, and that's what the president wants open.
Crude at the moment just short of 107 on Brent, WTI at about 95. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. A 31-year-old man carrying multiple guns and knives charged a Secret Service checkpoint at the White House Correspondents' Dinner Saturday night. One officer who was wearing a bulletproof vest was shot and was taken to a hospital. The acting Attorney General says the suspect was targeting members of the Trump administration. Domino's Pizza reporting first quarter results that missed analyst estimates. The CEO of the pizza chain saying the company is facing, quote, an intensifying macro and competitive environment. Domino's is hoping to open 1,000 new stores globally this year. United Airlines CEO saying its pursuit of merger talks with American Airlines has ended. In a press release, Scott Kirby writing, I approached American about a combination because I thought we could do something incredible for customers. American declined to engage. And that is your Bloomberg Brief. John.
Vonnie, thank you. I suspect they still think we can do something incredible for customers, combining with another airline in the sector.
And to me, my question is, how big is their emphasis on the international revenues that really are going to drive profitability going forward, and how much are they trying to pick up domestic gates? And that will depend on which airline they really set their targets on.
Up next on the programme, we'll head down to Washington, D.C. Peace talks on hold.
We have all the cards. We'll deal by telephone, and they can call us anytime they want.
The ceasefire remaining. Will you continue the ceasefire?
Haven't even thought about it yet.
Up next, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. This week, tons of tech earnings. Check it out. Alphabet Wednesday, Amazon, Meta, Microsoft, Apple later in the week. The gains so far this month, Microsoft up 15%, Meta up 18%, Alphabet up 20%, Amazon up 27%. Some major moves for big tech.
And you've asked a really good question throughout the morning, which is how much have these companies actually gotten better in terms of their prospects, and how much have people actually flooded into these names to haven, and could they actually lose clout should there be a resolution to the war in the Middle East and people change their focus back to a broadening out or some other trade?
So one or two things I'd point to. There are many, but here's one or two. One, it's refocused minds on the things that they have confidence in. This over everything else right now. We'll get to the everything else in just a moment. And two, it was odd coming into the new year when you saw the big spenders, the hyperscalers, ramp up spending. And we went through those major CapEx figures, CapEx intentions for the biggest companies on the planet, and you didn't see a move in Nvidia. And it just carried on moving sideways and doing nothing. That was kind of strange.
And so now people are waking up to the idea that that money has to go somewhere and be spent somewhere. And guess what? That's why we want to own semiconductors. And the reason why we've seen an 18-day stretch of 39% gains in that particular area. Can that continue? And at what point do they start to care about what's going on in the rest of the world? That remains a question. I keep thinking about the conversation we had last week with an analyst who pointed to supply chain constraints within the chip universe. Do we start hearing about that on the calls? And could that stymie this idea that it is completely isolated in a glass box away from everything else happening?
We mentioned this repeatedly last week. It's not a disconnect. It's a time horizon difference. The tech story's in the future, a better future, we hope. The present story, not a good one right now. And this speaks to that. Brent and WTI, front month of the futures curve. Close to 108 on Brent earlier on this morning. Up every single day last week. Up again so far this morning. Building on those gains, not just at the front month, but also in the latter months as well. That tension coming to the surface.
Right, because we're seeing extreme inventory drawdowns. And even though the United States has been relatively insulated, you are seeing the shocks that have moved through Asia and have moved through Europe. And at the moment, even though you do have this Axios report that maybe the Iranians are saying we could do some sort of maritime negotiation on the Strait of Hormuz, you have Mohammed Ghalibaf talking about actually we have more levers we can pull when it comes to pipelines we can hit or the Bab el-Mandeb Strait we can hit. So it's not looking optimistic, especially when on the ground the facts haven't changed.
Under surveillance this morning, peace talks on hold.
We have all the cards. We're not going to spend 15 hours in airplanes all the time going back and forth to be giving a document that was not good enough. And so we'll deal by telephone, and they can call us anytime they want.
The ceasefire remaining. Will you continue the ceasefire?
Haven't even thought about it yet. They offered a lot, but not enough.
So here's the latest this morning. Tehran reportedly proposing an interim deal to reopen the Strait of Hormuz, pushing off nuclear talks. Bloomberg's Tyler Kendall has the latest with more. Good morning, Tyler.
Hey, John. Good morning. Well, at this point, it appears that the negotiations remain at this stalemate, though Axios is reporting that Iran has presented through Pakistani mediators this fresh proposal that could include a reopening of the Strait of Hormuz in exchange for the U.S. lifting its naval blockade. The thing is, this White House has maintained that that's not going to happen. In fact, CENTCOM confirmed over the weekend that it had intercepted another U.S.-sanctioned vessel that has carried Iranian oil, and officials have outlined to us that they view the blockade as leverage, especially if it appears that Iran is now pushing to postpone dialogue when it comes to its nuclear program. In fact, Iranian state media put a little bit more of a finer point on this fresh proposal, including that it has some other points of contention in it, including that Iran would like to see a new legal framework for the Strait of Hormuz, compensation for damages, and also some sort of pledge that the U.S. and Israel would not attack Iran again. Now, despite all of this, John, President Trump still maintains that diplomacy can be a viable option, even as he pulled back on sending his special envoy, Steve Witkoff, and his son-in-law, Jared Kushner, to what was expected to be planned talks in Islamabad over the weekend. But as you heard him say there, he's now suggesting that maybe peace talks could happen over the phone, telling reporters that Iran can either come to us or they can phone us.
Tyler Kendall with the latest in Washington. Tyler, thank you. To build on that, Henrietta Treyz of Veda Partners writing, it's hard to see how the Strait reopens for business, absent military escalation, which President Trump has been trying to avoid in recent weeks. Henrietta Treyz joins us now for more. Henrietta, welcome. What does that mean for the diplomatic effort ongoing as we speak?
I think the diplomatic effort is extraordinarily complicated. And I really like to bring it back to tax policy because I think it makes so much sense. So long as the IRGC, which is a state-sanctioned sponsor of terror, has the ability to collect a toll, and EU nations, any Western banking country has to go through the Strait and potentially pay a toll or pay a tax, that is the end of the story. That cannot be permitted. I've spoken with international nations, international business groups. They will not engage in that communication and that tax component. And so those negotiations are incredibly tricky. I wish that there were more deputy level negotiations going on. That would give them something to build off of, give a reason for J.D. Vance to spend those 15 hours on a plane that they just don't have right now. So we're in this stalemate for a very long time. And you're going to see the inflationary impacts of it for as long as that's the case, and then well after.
If the people you're talking to say a toll is not permittable, then what could potentially be acceptable?
That's sort of why I say I don't see a path forward that doesn't include a military component or a really expanded coalition that brings in the EU and also China to have a negotiation with Iran that allows them to move away from controlling the Strait, which is both cheap and inexpensive and easy for them to do at this current time. And that's why they've been in control of it for so many days now. I think that we either need to see more military escalation, which the president is averse to at this point, or we need to get EU and China in the game to a greater extent.
But at the same time, this White House is definitely focused on rising gasoline prices. On Friday, we were talking about the waiver when it comes to the Jones Act. When you talk to members of Congress, what are they prepared to do?
There's a flurry of amendments that are filed across all kinds of inflationary pressures. So there's a ethanol fuel blending amendment that will be attached to the Farm Bill that the House is going to vote on this week. There are a whole host of fertilizer-related amendments because those prices are going through the roof. And according to the Farm Bureau, 70% of U.S. farmers have not bought their fertilizer for the next planting season. So there are a number of small-scale efforts at the House and the Senate level to get some price controls. But the big two are really a gas tax holiday, which will not be included in this reconciliation bill, but could theoretically be done via executive order if President Trump really wants to push the envelope, or imposing an export ban, as y'all have been talking about this morning.
This is something that I'm sure bond investors are listening to and saying, oh, no, not again, because ultimately what ends up happening is if there are fiscal responses and levers that are pulled, then people keep spending and prices will stay high and go higher, and suddenly it becomes a stickier kind of consequence. How much discussion is there about that type of economic ramification in Congress?
It's weird. I've been on the road for 2 weeks now with investors, and I hear in the litany of reasons to be optimistic, always some sort of allusion to a fiscal spend, a fiscal package. It makes sense. We're doing a reconciliation bill. And remember, the last one was $3.5 trillion of fiscal spend, including a big thing that we talk about when we're considering how consumers can handle either the tariffs or the higher gas prices. We've got the one big beautiful bill. People are getting money back. I think investors are like primed to understand that reconciliation means spending. So that maybe makes sense. But this reconciliation bill that they're working on right now does not include any fiscal stimulus. It's anywhere between $70 and $140 billion of spend just to keep ICE and DHS open. But there's already talk of a third reconciliation package. And I don't think there's going to be much in the way of fiscal in that one either, although there will be, maybe a $300 billion price tag associated with it. But it's this weird contrast of the Strait expecting D.C. to do something to help the U.S. consumer. And then, as you point out, bond markets who are like, please don't.
Well, there's a question about the political appetite right now to give some sort of support. Is there some kind of fiscal discipline here, or is this just a lack of support for making it easier to continue the war? I mean, which is it? Because, it'd be great if people came out and said, wow, they found fiscal religion. On the other hand, it does seem like there just is a sense that, please, resolve this already.
Yeah, I mean, don't go so far as to say fiscal religion. We have a real debt crisis in the United States, and that's not something we're resolving right now. But as you go into the midterm elections, you have a lot of Republicans, particularly on the House side, who want to see fraud, waste, and abuse trimmed. Jody Arrington, the House Budget Committee chairman, has a $180 billion, tweaks that he'd like to see that would streamline things like the earned income tax credit. We're not talking about changing the retirement age or fixing tax policy in the country. That's nowhere right now. That's not happening.
Henrietta, when you travel around with investors and you're talking to them, are they at least breathing a sigh of relief when it comes to the future of the Federal Reserve?
Yes, definitely. Obviously we're glad to see that the White House capitulated to Senator Tillis, and Senator Tillis in response has said, okay, I'm fine voting forward Kevin Warsh here. But expectations on the street have come in, not because of Warsh, and not because of the positive developments in terms of his advancing his nomination, but because of the war. There's a lot of confusion on the street, quite frankly, about why gas prices are so low when we haven't seen material demand destruction in the United States, things like 5% less than what we had at the start of the war. And the war continues and the Strait remains closed. The Strait remaining closed is a compounding, cascading thing, and we're just waiting for the data to hit. That's really the vibe I get from investors. And the Warsh component is fantastic, but you can't cut rates in a rising inflation environment. When Lufthansa's cutting up 20,000 flights and Air Canada's canceled flights to JFK for the next 5 months. I mean, you can see the cascade coming, and investors are basically just waiting for it.
But just quickly on the Fed, the Inspector General is still going to be pursuing a separate probe. Can that potentially muddy the waters?
I actually expected it to muddy the waters so plainly, and the reason I say that Tillis and the president negotiated a ceasefire of their own and an off-ramp here is that there is plenty of room, and Piro's own statement made it clear that if anything warrants, they'll reopen this investigation. My conversation with Senator Tillis strongly suggests that Jay Powell will stay at the Federal Reserve for some period of time after May 15th. So I think maybe that's the backstop that he's relying on now, and I think Powell's comfortable with that. I think Senator Tillis has been given those assurances. And again, as you know, a lot of the members on the Senate side in the Banking Committee and elsewhere in the conference really like the idea of ensuring fiscal independence for the Fed, and they appreciate what Senator Tillis has done for the last couple of months here.
Henrietta, thank you for your input. Henrietta Treyz of Veda Partners. It's making Wednesday afternoon a little bit more interesting for the Federal Reserve and Fed Chair Jay Powell. This morning, things are interesting for one specific reason. It's Qualcomm. It's up in a pre-market by 13% so far this morning. Chips have had a major run. There's a rumour, I think you could call it a rumour, based on a report that maybe you have some kind of tie-up with OpenAI. And that stock is absolutely exploding higher so far this morning.
Yeah, and it's interesting because OpenAI has been both a liability and a boon to a lot of the chip makers, given the fact that people were worried about cyclical types of financing. Right now, we seem to be back in boon phase, which might give a tell to how people will trade on Wednesday.
Nasdaq futures up by 0.2% so far this morning. Up next, we'll catch up with Jonathan Krinsky of BTIG with chips on a record-winning run. Live from New York City, you're watching Bloomberg TV. Equity futures just about unchanged on the S&P 500. Record-winning run on the Nasdaq and the chip stocks. The SOX, the chips index, The Philadelphia Semiconductor Index on an 18-day winning run over that period, up by 40 to 50%. This month alone, Bramo, you keep giving us the number. This month alone, up by something like 40% for that index. Unreal.
Yeah, it's just been a moonshot. And some people could say, well, what took so long? This is the catch-up trade. And then you see things like Qualcomm this morning coming out and seeing another boon at the potential of a tie-up or some sort of agreement with OpenAI. And you wonder, maybe this has more to go, because ultimately it is the one area that people can keep investing in. And if Russ Koesterich is right, that people reward some of the big tech names for spending that much more, well, some of these names might be to the moon.
13% move. Yahara's going to have more on that for you in just a moment. Let's turn to the commodity market. Brent and WTI, big run here as well. Up every single day last week for Brent. Up again this morning by just 0.5%, 105.89. No sign of any diplomatic breakthrough over the weekend.
And remember, we were supposed to see talks this weekend, and they were pulled. J.D. Vance, Steve Witkoff, Jared Kushner were supposed to go, and then it was just Steve Witkoff, Jared Kushner were supposed to go, and then those talks ended. The president saying, I'm not sending my envoys there to have these very long flights, and then nothing materializes. Axios is saying there's potentially a deal on the table. Put the portfolio of nuclear down the road. That's going to take months, to maybe even years, to get to some agreement. But let's discuss the Strait of Hormuz. And even then, the market isn't really buying it this morning.
Let's turn to the bond market briefly. 2s, 10s, 30s. Yields up just by maybe a basis point or so. On 2s at the moment at 378. On 10s at 430. It's amazing how much of a sideshow the Federal Reserve has become. It's not the centre of attention for the week ahead in quite the same way it has been in months gone by.
Even with the drama, because ultimately people are looking at what the Fed could potentially do to affect this economic cycle. They're as clueless as everybody else, and they're trying to track exactly the balance of risks. They're subject to potentially oil prices remaining higher for longer, and a real question about the employment figure that seems to be actually firming up. So it's a sideshow because they're not going to do anything, and it's a sideshow because people can't game it out. Throw that in the bucket of uncertainties.
Jobs Day, not this Friday, by the way. It's coming next Friday. Totally. Gonna have to wait another week longer for that. All right. 2 hours away from the opening bell. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We have a few earnings to get through. We start with Domino's. Shares are falling 3.8% after same-store sales growth came in well below expectations, with the CEO pointing to a tougher macro environment amid rising competition. And analysts say that the pressure could pile on for this name because it is more exposed to lower income consumers who, as we know, are getting squeezed by those higher energy prices. Turning to another earnings story, Verizon, it was a beat and a raise for that name, so shares are up 3.6% in the pre-market, the largest U.S. wireless carrier, surprising the markets with a gain in phone subscribers when analysts were expecting a loss. So that's showing some early traction under a new CEO who just took the helm 6 months ago. And we end on Qualcomm, the chip maker, up nearly 14% in the pre-market on this report that it is teaming up with OpenAI to make smartphones. This is something we know that OpenAI has been interested in ever since it acquired Apple legend Jony Ive's startup last year. And while this is just a report and still years out, investors clearly excited about the prospect of OpenAI smartphones. John?
The parabolic move in chips continues this morning. Yahara, thank you. On our radar this morning, Iran offering a new proposal for reopening the Strait of Hormuz. Axios reporting the deal hinges on the US lifting its naval blockade and postponing nuclear talks. Elsewhere, President Donald Trump praising the Secret Service following the shooting at the Correspondents' Dinner. The president addressing the delay of his evacuation.
What happened is it was a little bit me. I wanted to see what was happening, and I wasn't making it that easy for him. I wanted to see what was going on. And by that time, we started to realize maybe it was a bad problem.
The suspect in the shooting is set to be arraigned later on today. And finally, a high-stakes earnings week on deck for the Magnificent Seven on Wednesday. Results from Microsoft, Amazon, Meta and Alphabet, with investors seeking updates on AI spending. Apple rounds out results Thursday after the close.
I'm incredibly interested in Apple in particular, given the fact that they now have new leadership and potentially need to show some bold moves to really take them into the next cycle. More importantly, I question how high the bar is heading into this earnings cycle, given the fact that these have been the haven names. Do we see some sort of embrace of any kind of optimism in a new way, given the fact that people seem to come around to the idea that this is probably real and it's probably the best bet that you have right now, given all the uncertainty everywhere else?
I feel like these earnings need to confirm or justify justify the rally that we've seen? And if they don't, how much do the concerns then seep back into the market about what is actually going on when it comes to the conflict? Because the facts on the ground when it comes to the Strait of Hormuz and Iran have not changed.
Well, to Lisa's point, to some extent, they've been amplifying the move in chip stocks. You call them the haven names. I think that's really important. Can't buy bonds right now if you're worried about inflation. What can you lean on? What do you have a high degree of confidence in? And a lot of people seem to be turning to the tech story once again.
I love the idea of the market as a human who doesn't have a lot of attention, and the attention span can only really focus on one or two things at a time. And it feels like right now international noise is becoming noise because ultimately it's just fuzz. You can't really analyze it or get an edge. So people are going and over-analyzing what they can get an edge on. And tech very much is rife with pockets you can analyze, and people are going wild.
The run continues. It might become day 19. Chips extending a record run with 18 consecutive days of gains. Jonathan Krinsky of BTIG writing, well, we've been wrong on calling an end to the semi-run. We think the window for a meaningful downside reversal is very close. Jonathan joins us now for more. Jonathan, welcome to the programme. Let's just start with a big, important question, just to reflect on things. How reminiscent is this of some of the price action we saw into the early 2000s top?
Well, it's in some ways it's the closest we've probably seen since then. On the other hand, there's many metrics you could look at that say we're well away from the extremes we saw at that point. So, you know, it depends what you're looking for, but certainly it's the closest we've probably seen since then.
Well, let's compare it to, say, where we are relative to the 200-day moving average, Jonathan. How big is the gap now? And when was the last time it was this wide?
So we closed Friday about 48% above the 200-day moving average on the Philadelphia Semiconductor Index. That is the widest since 2000. But just for perspective, we got to about 100% above the 200-day at the peak in 2000. But on the other hand, there's some other things to look at, such as the rate of change over the last 18 days. And when you look at that 18-day rate of change, it's the biggest into a 52-week high on record. And I think that the telling part is a lot of times when you see these big surges see these big 18-day surges, they come in bear markets. They come after meaningful drawdowns. And, you know, to put it in perspective, the second biggest move was in June of 2000 off of, you know, after you already had about a 60% correction in the semiconductor index. This is coming off just a mild 15% correction that it didn't even break the 200-day. So it is quite literally the definition of a parabola. And we've been saying for the last few days that parabolas end only in one way, and that's equal and opposite fashion to the direction they came from.
So I'm wondering about the other technical factors behind that. You said that normally this only happens after a bear market. Some people might argue that there was essentially a bear market, not necessarily in actual price level, but the fact that people weren't investing in this sector, even with some of the promises of spending by the big tech names. How much are you seeing people now fully invested or over-investing on a technical flows backdrop?
You know, look, I don't think you could say that people weren't investing in semis. I think you saw this rotation within semis. I think that, you know, the kind of the two leaders last year, this time were kind of NVIDIA and Avago. Those peaked out in the summer, but then as that was happening, you had this big rotation into the memory names, the DRAM names, so names like SanDisk and Micron, and those kind of carried the baton for a while. And then now we're kind of seeing everything rally. And that's also another sign when you see names like Qualcomm this morning that's been kind of a dog in the semis, some of the analog names that really haven't done anything for the last year or two, and even those are getting a bid. You know, that's usually the sign that the sector in question is kind of on its later innings. And again, this type of move into a new high is what is the literal definition of a parabola. We saw it in gold in January, February. We saw it in a single name like Avis Budget last week. So we've seen this story before. Again, I don't think this move ends in a shallow sideways consolidation. It could go a bit higher. We're seeing that this morning, but ultimately you get a pretty sizable retracement when following these type of moves.
Jonathan, do you feel like this sector is isolated in, you can call it parabolic moves, you could say bubblicious types of behavior, going wild, I mean, whatever you want to characterize it as. Do you see them as isolated, or do you see other pockets of the market that seem to be trading in tandem and have similar characteristics?
Yeah, so one of the things we looked at is the high beta momentum long index put out by Goldman. And that basket really contains a broad based basket of the AI names, whether it's electrical components, the optical names, infrastructure. We actually put out a chart of Caterpillar overlaid with the semiconductor index, and it's well over a 90% correlation over the last couple of years. It's essentially the same chart. So there are a lot of names in this AI theme that are exhibiting similar behavior. And again, it doesn't mean that the final top in the AI trend is here, but certainly this sort of price appreciation is vulnerable to a near-term correction, again, in equal and opposite fashion. So, the fact that we've seen a 40% move in the last couple weeks in some of these names, it's likely to give back a large portion of that.
Jonathan, you're basically saying that it's anything that touches AI.
I don't know about anything, but certainly a lot of the most popular and well discussed and known themes among AI are certainly having a big rally. But yeah, I wouldn't say anything, but there's a lot of touch points here that are certainly having this trend.
Jonathan, that line you keep repeating, and it's in your research as well, equal and opposite. Equal and opposite. Why does it have to be that large?
I mean, again, just look through our history. Gold we saw in January, and silver. We saw an Avis budget where the stock went from 150 to 850 and then back to 200 in 3 days, right? So that's just the way that markets work when you have this kind of, I would call it an unnatural advance the last couple of weeks, right? I mean, I don't think we've ever seen any asset or anywhere go the entire month without a down day, and we're 3 days away from that with semis. We saw something similar in Meta stock last February, early February, where it was up 20 straight days. And that's just the way when something goes that amount of time without a pullback, that's unnatural, and it only ends by kind of a reversal of that. That's just what we see throughout history. So again, it doesn't mean we're going into a bear market for semis, but I would expect a pretty good retracement once this kind of blow off completes itself.
Jonathan, appreciate your time and your perspective. Thank you. Jonathan Krinsky there of BTIG. An interesting note over the weekend.
I just wonder if Jim Zelter were here. Take a walk, touch grass.
I'm not sure if Jim's talking about a parabolic move in chip stocks when he makes those comments.
But there are a lot of people who feel like there is something substantial that has changed. And we haven't seen earnings like what we've seen so far. We could potentially get spending plans. That said, when something goes parabolic, I mean, all of our antennas go up, and we're all, used to looking for black swan moments. And so, maybe this could be something that gets reversed.
And not a single down day for that sector through April so far. First quarter felt like a lifetime. April's just gone like a flash. What's that about?
I can't really tell you,
right?
Because
April's gone really, really quickly.
Maybe it's just sort of, if you're on a hike after like the 15th mile, you no longer think about life anymore. You just sort of keep going, and then it goes quickly. So maybe it's something like that.
It goes faster as you get older, right? So maybe the first quarter just aged us all.
We're still in April.
And now time's just flying by. Right?
I don't know.
Maybe
well, the fact that we've got time to talk about this means that, clearly it is flying. No, I take your point.
We've got things to cover, important things, I'm told. Let's get you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The man accused of storming the White House Correspondents' Dinner spent years acquiring his weapons arsenal. Cole Thomas Allen sent a lengthy manifesto to family members that was seen by Bloomberg, where he appeared to blast President Donald Trump as a, quote, traitor who committed crimes. Iran is offering the US a new proposal for potentially reopening the Strait of Hormuz and ending the war. Axios is reporting the offer postpones nuclear negotiations to a later stage. President Trump is expected to hold a meeting with top security and foreign policy officials later today. Elon Musk says he's nearing his goal of turning X into an everything app. He plans to launch a new financial services tool called X Money this month. The banking and payments platform would offer 3% cash back on eligible purchases, a 6% interest rate on cash savings, and free peer-to-peer transfers. That's your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, cleared for confirmation.
I am prepared to move on with the confirmation of Mr. Warsh. I think he's going to be a great Fed chair. This will allow Mr. Warsh to move on with his confirmation on time.
Collin Martin and Charles Schwab joins us next. Futures unchanged this morning on the S&P 500. On the Nasdaq, we had some weight to it, up 0.2%. Qualcomm, what are you doing? Up by double digits in the pre-market on a story. I stress a story. Connected them to OpenAI, and the gains continue.
Yeah, and it's specifically with a new kind of phone device. So this is where Qualcomm really surges. And the whole idea of people matter. Johnny Ives, the person who really designed the iPhone, coming in and working on this with OpenAI and Qualcomm, leading to a 13% gain after the gains we've already seen, which is just giving you a sense of the moonshot.
It's going to be day 19 potentially for the semi-index here stateside. In the commodity market, Brent and WTI look like this. Brent crude around 106, up by about 1% this morning. WTI higher as well at 95. Going into the Fed's next meeting this Wednesday, a lot to look forward to. Under surveillance this morning, cleared for confirmation.
I am prepared to move on with the confirmation of Mr. Warsh. I think he's going to be a great Fed chair. This will allow Mr. Warsh to move on with his confirmation on time. And then Mr. Powell will have to make his own decisions at some point in the future about when and if he leaves the board before the end of his 2028 term expiration.
So here's the latest this morning. The confirmation of Kevin Warsh clearing a massive hurdle ahead of Fed Chair Jay Powell's potential final rate decision leading the central bank. Collin Martin of Charles Schwab writing, this doesn't change our monetary outlook for the rest of the year. We expect 0 or 1 rate cut by the end of the year. Collin joins us now for more. Collin, good morning.
Good morning.
Plenty of drama. Are you saying it's not that relevant for the look ahead, for the look out, for the outlook?
Not in the short run, no. I mean, it's a committee of 12 voting members, 19 full-time members, and clearly the shift has been to a wait-and-see mode as opposed to a we need to cut. There were only a few officials who were in the cut mode. Myron, who is giving his seat up to Warsh when he gets confirmed, and Waller has shifted a little bit. So our math doesn't change. There's plenty of officials who are worried about, the stickiness of inflation, the impact of higher oil prices. So I think it'll be a pretty high bar for Warsh when he comes in to build consensus around the idea of rate cuts anytime soon. So with that outlook, an extended pause, maybe they cut by the end of the year, but for the next several meetings, probably just wait and see.
This from Andrew Honhorst of Citi just moments ago. It makes guidance from Powell at this week's meeting less market relevant. Goes on to say, if anything, we see modest hawkish risk on Wednesday. What does hawkish risk look like this Wednesday?
I'd say the risk for an extended hold, we saw in the last meeting that there was a discussion about the two-sided risks and maybe the need for hikes. I don't think most officials are there right now, but I agree that Powell's comments are going to be less focused on his view and more about what the committee's saying. I think he usually does a pretty good job of representing the committee, but his views are not going to be as relevant after this meeting. I do expect a lot of the questions from the various journalists in there might be more about him and his outlook, whether he stays on or not, than versus actual monetary policy. But he'll do his usual tap dance around it and be tight-lipped about what his plans are.
Yeah, it'll be more of an Oprah episode than really an FOMC meeting. I am curious from your perspective, though, how you would respond if there is somebody at the Federal Reserve who does not want to necessarily cut rates and you start to get fiscal stimulus to try to offset the potential hit to consumer spending as a result of what we're seeing in the oil market?
In that situation, we probably see higher yields. If we see more fiscal stimulus in an economy that's doing okay. The last 2 quarters, a little bit choppy, but I think overall the labor market's relatively stable. If we got fiscal stimulus that then could give a boost to spending, I think maybe you see yields move up a little bit from here.
I feel like this market is asleep, the bond market. And I don't mean in a bad way. I mean happily, like on vacation, touching grass and taking walks. It feels like, you could throw everything you want at this, whether it's issuance from governments, whether it's potentially a drama at the Fed, whether it's an oil price shock, whether it's massive, potential capex coming from big tech. Everyone's fine. It's just, basically flatlining. Can you understand why?
Well, I think overall the factors that we saw coming into the year are still very much in play. And to your point, we have been very much range bound right now. The 10-year has been between, say, 4.25% and 4.5% for a handful of weeks right now. Inflation is still sticky. Fiscal concerns haven't gone away, and we've seen a move up in global bond yields. I think the market's probably looking for some sort of catalyst right now. I don't know what that catalyst is, but the idea that maybe oil spikes even higher to pull yields up, or maybe we start to see cracks.
I'm sorry, I'm laughing. A catalyst, you got 15. Which one? I'm seriously, what could actually shake this market that does seem to be bulletproof?
Yeah, I think that's the million-dollar question. Right now, the market seems to be very calm. Even all markets, stock market, bond markets, about everything that's going on in the Middle East right now. I worry that the longer it goes on, the higher oil prices remain elevated, which means higher gas prices here, lots of input prices. That can weigh on consumer spending. It can weigh on business confidence. We've already seen it weigh on consumer confidence and business confidence. I worry that the length of this results in more downside risks. I agree that so far that has not come to fruition. Stocks keep going up. Credit spreads remain low. Treasury yields are in a tight range. I worry that there's more risks to the downside if this continues to go on.
When it comes to the Fed drama, can we just sit on this one thing that we do know is going to happen? The Fed Inspector General is going to be looking into the probe. With that hanging over the Fed's head, could Powell step aside?
That's another $1 million question, and we've been talking about that with our team at Schwab of how does a potential lawsuit for Powell play into his decision-making. But the short answer is I just don't know.
He said it would need to end with transparency and finality. I've got no idea what he ultimately does. By his own metric that he set for us at the last news conference, I'm not sure if the events of the last week met that bar for him to step aside and move away from the Fed board.
Yeah, does he give some sort of new litmus test for exactly what will be his characterizations for what could make him leave?
He can maybe massage it a bit and say, well, since the DOJ is dropping it and I trust the Fed Inspector General, I'm happy to move aside and go on retirement and golfing, et cetera. But I do think he has to offer some clarity at this meeting, given we are 2.5 weeks away from when Kevin Warsh will be the next Fed chair.
I hope he takes the off-ramp in the same way that others have taken the off-ramp, because don't we all want to move on from this mess and this drama around the Federal Reserve?
What I find amazing is the market already has. The market doesn't care. I mean, honestly, it seems like people are saying, OK, Kevin Warsh is going to be there at some point. Jay Powell will leave and go on vacation. Good luck to you. And in the meantime, we're looking at a Fed that's basically sidelined. It seems like the market doesn't care. And I think that is actually really important, even with inflation expectations going forward. Not budging, really, away from that 2.2%.
But will the market care if Jay Powell comes to the podium and says, I'm going to keep my governor's seat till 2028? That'll be a lot of drama.
I think that makes it more controversial than it needs to be,
Yes.
which is why I think, take the off-ramp, head to the exit. Let's move on. Let's focus on the data. Data's been OK. Data's been all right. It's been better than OK. Jobs data's been really good. ISM PMI's been fantastic. Park you, Mitch. If you didn't have you, Mitch, and you focus on everything else, data's been good.
If you're a Fed chair and you want to look back and said, mission accomplished, and things are looking good, probably the better time to say, OK, I think I'll go hit the golf course.
Right?
I think so.
Collin, thank you. Appreciate it. Keep you out of that. Collin Martin at Charles Schwab. Keep you safe. Less controversy. Move on. We all just want to move on. I'm pleased the DOJ has moved on. I hope the Federal Reserve can just move on with new leadership that is going to be confirmed by the Senate and gets overwhelming approval by most establishment figures in the world of economics.
Yeah, I just wonder what will actually shake this market in any capacity whatsoever. I mean, what scenario would actually give this market pause that either there's going to be a real loss of Fed independence in some capacity, whatever that means. People say that it already has happened on the margins, whatever, versus also wondering when inflation really starts to get unmoored. How high is the bar to hike rates again? And that, I think, is going to be an interesting question.
That's the most important question. What does Kevin Warsh stand for? What's his reaction function? Does he make an argument to reduce interest rates, or is he open to tighter policy in the future? They're the kind of things we need to focus on in the months to come. Coming up, we'll catch up with Kristen of Citi Wealth. We'll speak to Olivia Wassenaar of Apollo, Greg Daco of EY, and Dan Niles of Niles Investment Management.
You're seeing kind of everyone, I think, look to, OK, what else can benefit?
If we didn't have this boom in tech, we would be looking at a much worse situation.
The geopolitical is just not factored into anything right now.
To maintain the optimism, we need to continue to see earnings coming through.
The stock market's been remarkably strong, and I think it continues to do very well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action, the scores look like this. 4 weeks of gains on the S&P, looking to add to those gains this morning. Up by another 0.1% on the Nasdaq, just about unchanged on the S&P 500. Later this week, a week full of central bank decisions, punctuated by the Federal Reserve on Wednesday. And through the week, after the closing bell on Wednesday, tech earnings pick up in a big way.
Yeah, it's the central bank of the world, which is big tech. You've got the G7, all G7 nations reporting when it comes to the central bank meetings. But then $28.8 trillion of S&P 500 market cap reporting this week. This really is where all eyes are. Again, how high is the bar for big tech, given the fact that they've been the haven place and the place everyone's been hiding out amid a lot of volatility, at least in headlines?
The bar seems very high, almost to justify the rally we've seen. Jim Reed of Deutsche Bank over the weekend was talking about the talk of an AI bubble from last year has receded for now. The powerful growth story continues to propel the sector forward while significantly offsetting macro and market concerns around the war. What if they don't reach that bar? Does the market then go back to the concerns of macroeconomics and what is happening in the conflict?
Qualcomm on the pre-market just adding to that rally for the chip sector. 18 days, a record could become day 19. Qualcomm in the pre-market is up by 12%.
And this comes in the heels of discussions or reports of discussions with OpenAI on a smartphone. This is interesting on a number of levels. Qualcomm specializes in some of the smartphone components. They would be working with someone who designed the iPhone, Johnny Ives, formerly of Apple. And then a real question here about the monetization of AI, the commercialization of some of these products. This gives an opening to the idea of how products can get into our worlds that actually have some of these details. And that, I think, is what people are getting excited about.
It's been such a crazy run for this sector. It's just insane. The gains we've seen, we haven't had a down day for this month so far, which is crazy. And then you hear from Jonathan Krinsky of BTIG, just focused on the technicals, that this needs to end in the equal and opposite direction. That's what he's forecasting here. A major move in the other direction.
Yeah, and ultimately, I mean, I did get some messages while he was talking. Someone called him Cranky Krinsky. I mean, there is a sense that people felt like, fairness, like just because he was coming out with a negative projection, but there's this idea that there could potentially be...
I don't think you can dress that one up, Bram. It's pretty brutal.
Okay, but I don't think so. I think it's important to show the technicals. Let's move on.
You want to move on? I'll set up the next hour? I'll do that. All right. Coming up on the programme, lost it. We'll catch up with Kristen of Citi, heading into a busy week on Wall Street. Greg Daco of EY expecting the Fed to hold steady on interest rates. Dan Niles of Niles Investment Management previewing major mega-cap tech earnings a little bit later. Still lost it, by the way. We begin this hour with stocks stalling. Still lost it at all-time highs and crude rising. Kristen of Citi Wealth writing the following. Use volatility as an opportunity to lean into structural themes tied to energy, independence and sovereignty, supply chains for the next generation of AI implementation and fiscal spending. Kristen joins us now for more. Kristen, good morning.
Good morning.
Not tying your outlook to this cycle. What's the reason for that?
Well, I think, okay, so if we look at where the market's trading right now, there are a lot of comments around at all-time highs, can this sustain? The reality of it is that being close to all-time highs is actually normal, that the market is trading generally 50% of the time within 5% of an all-time high. So we have to look through to the actual earnings and fundamentals and say, can that support that? Which is why I think this is a monster week. We need to say, okay, if earnings continue to grow, we've had 8 consecutive quarters of double-digit earnings growth in the U.S. market. If that sustains, then certainly this investment is going to sustain, and then we're going to see the market climb higher.
We hear these kind of words a lot. Anchor yourself to structural themes, secular tailwinds. I do wonder how cyclical some of these secular stories are, which might not make sense, but let me pick a single name.
Let's do it.
Say Meta. Meta's a great example of that. That's quite a cyclical company, dependent on a lot of ad spending, and I wonder how well it stands up later this week.
Yeah, so if you broaden it out to the, let's call it Mag 7, Great 8, Elite 8, I think we just have to go back to this earnings story and then say, okay, these hyperscalers and where they're investing, do they have the money to continue to do that? So you have one part of the equation that's that. Then you lean into the fact, where's this money going? I think that was something we were talking about at the beginning of the year that we seem to ignore entirely. It wasn't about the war in Iran. It was all about, where is this money? Is it too much? What is the ROI? People are holding companies accountable for that ROI, but we have to remember that's flowing through into the economy, whether it's infrastructure, whether it's energy. So a lot of these kind of secular growth trends, we want to follow the flows.
Russ Koesterich of Blackrock earlier was saying that the market seems to have moved on from punishing some of the big tech names for announcing some of the big spending plans. Do you think that that's true, that we're going to see that this earnings cycle as well?
I think you're either on one side or the other side of this trade. On one side, you're saying, okay, we're becoming impatient and we want to see the ROI. On the other side of the equation, it's actually, are we in early innings? And I think the truth of it is you have these hyperscaler companies who have strong balance sheets, yet they've started to use debt to be able to finance a lot of this. However, they are continuing to deliver on earnings, funding all of this investment. And then I'm in the camp of this is really early innings when we look at the productivity gains and what this could mean, not just this quarter or this week, but really looking out to 2030 and beyond.
Do you see any scope for some ramifications from the war in the Middle East, given the fact that there's a question about helium, about chip transportation, around security issues? I mean, how much do you think that could bleed into some of these earnings reports that we get?
So I think this is something when I was talking about what the market was talking about in Q1, then the war in Iran, the market seems very unit-focused, that you can only have one narrative at once. And so right now, we're not discounting any of that. That I think what the market is looking at is what is the probability of a re-escalation? And the market's completely ignoring that this is something that could drag on for an undetermined amount of time. So what I would say to anyone who is worried about that, you have to make sure that you're diversified in your portfolios, and you have to make sure that you're taking advantage of hedging strategies, because we could see some volatility if we don't have a resolution to this conflict.
What do you like in terms of diversifiers?
So actually very traditional diversifiers. So I'm going to sound very boring in this response. But when we look at fixed income, staying on the short end of the curve, intermediate duration, high in quality, the duration of our fixed income portfolios is averaging around 5.5 right now. But I also think staying kind of on the short end of the curve and cash equivalents, you're getting a decent yield there right now. So I think that's an important part of the portfolio. I think gold as a ballast to portfolios, that's something we've been talking about for quite some time. It's not a huge position.
It didn't really work in the beginning of the conflict.
It didn't work at the beginning of the conflict, but it also ran up so much. And it was such a substantial run with a lot of retail participation. So some of that was deleveraging, shaking out some of the broader bid and chasing that trade. But as a solid core position, I think it absolutely makes sense.
Why do you think it will start to work again? What are the forces that will generate returns?
So I think there's a couple of things. One, continued kind of central bank buying. We've seen that. Diversification away from the dollar. We still see a little bit of that activity as well. And again, it's not one of those things where we're saying it's a bullish play on gold. It's a portfolio diversifier.
It's funny how many conversations we've had 2 hours and 10 minutes into the programme and hardly talked about central banks. We've talked about the future of the Fed with regards to Chairman Powell versus Kevin Warsh, but not really talked about it as a relevant factor in the outlook for the equity market, is it?
I think rates are certainly a relevant factor for the outlook of the equity market. But I think the equity market is also saying, OK, we're going to get used to what could be a higher than pre-pandemic rate environment, a higher than pre-pandemic inflation environment, and we're not going back to those levels. So we have to start valuing companies in line with that and really kind of pricing out rate cuts for this year. I think there's like another bull case, though, for the U.S. equity market that we're not talking about, which is a supply-demand component. So we can talk about fundamentals, we can talk about earnings growth, but when we look at the supply-demand factor, there is a lot less equity than there was before in terms of companies staying private longer, share buybacks. There's been a de-equitization of the market. And then you look at the demand side. The demand side is also very, very strong in terms of all of the new participants that have come in. So you have another factor of people really eager to get into this market and buy.
Given all of that retrenchment, does it make sense that people are talking about tight central bank policy at the same time that you have a re-equitization of the market with all the IPOs planned for later this year?
Great question. I think time will tell. I think the re-equitization of all of the IPOs, we need to actually see them come to market. We have seen that pickup in activity overall. That will be quite healthy, and it's actually another kind of catalyst for market activity and action that we saw on the back of bank earnings. A lot of activity, not just from the trading side, but also the deal-making side, which is net positive.
Kristen, good to see you. Kristen,
good to see you too.
Citi, wow, thank you for being here. We could see some major IPOs later this year. SpaceX, OpenAI, Anthropic.
Yeah, and it changes the dynamic that Kristen was talking about, where it had been a shrinking pool of equities with all the buybacks and people saying private for longer. Suddenly, it's going to be a massive expansion with the biggest IPOs we've ever seen. Do people rise to the occasion and say it's a buying opportunity? Does it become a potential technical headwind? Most people seem to see it's the former, not the latter.
Savita over at Bank of America believing this might be a headwind for the market later this year. We'll see. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. A 31-year-old man carrying multiple guns and knives charged a Secret Service checkpoint at the White House Correspondents' Dinner Saturday night. One officer who was wearing a bulletproof vest was shot and taken to a hospital. The acting Attorney General says the suspect was targeting members of the Trump administration. Senator Tom Tillis is ready to advance Kevin Warsh's nomination as the next Federal Reserve Chair. Tillis says the Justice Department's decision to end a criminal investigation into current chair Jerome Powell removes a threat to the central bank's independence. United Airlines CEO Scott Kirby says the company's pursuit of merger talks with American Airlines is over. In a statement, Kirby said he approached American about exploring a combination, but they declined to engage. The CEO said he saw combining as a chance to create the best airline in the world for customers. That is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. More from Vonnie in 30 minutes' time. Up next on the programme, the Morning Calls. Plus, we'll catch up with Olivia Wassenaar of Apollo on opportunities in reliable energy. From New York City this morning, good morning.
We are 3 to 4 weeks before we hit the peak demand season, and this is what likely has been keeping a cap on prices, just a lack of demand, both from demand destruction because of higher prices, but also the normal seasonal demand destruction that we see in February, March, and early April. But that's about to change. Higher for longer, certainly through the rest of the summer into the third quarter.
That was Stephen Schork of the Schork Group. You see higher for longer in the futures curve throughout this morning. You've seen it building now for a while. So take the front month of the futures curve. We'll take WTI, we'll take Brent. Check it out this morning. Brent around 106, WTI at 95. Brent up every single day last week and up again this morning. But it's further out where things are getting more and more interesting. Not just later in the summer, but towards the back end of this year. You've now got Goldman this morning out with a report saying they now anticipate the fourth quarter will average $90.
Yeah, and that's $30 above where they thought before the war began at $60. That was the expectation. This, to me, is the more interesting aspect. And this is the boiling the frog aspect of this conflict. The longer it goes on, the more people are saying there are going to be structural deficiencies that are going to be hard to fill over the longer term and do mean the oil prices are not going to go back to where they were potentially anywhere in the near term.
Well, Goldman is talking about extreme inventory drawdowns if the Strait of Hormuz continues where we are now, this prolonged shutdown. This is why so many people I talk to feel like the market is broken, because what you see on your screen is not matching up to really how dire it is when it comes to the physicality.
It's not upending this equity market run, that's for sure. 4 weeks of gains on the S&P 500 this morning, just about unchanged. On the Nasdaq, up a tenth of 1%. Semis, 18-day record daily winning streak could become 19. Thank you, Qualcomm. Qualcomm up by double digits in the pre-market on a story of a potential tie-up with OpenAI, up 11% this morning.
Yeah, and a discussion about creating some sort of smartphone imbued with AI. I want to know more details about this. This is actually really interesting on two fronts. So number one, how much this fuels another round of the semiconductor that is tied more to the smartphone product, which is Qualcomm. And two, what does this do for Apple if it is true, given the fact that the person behind this is Johnny Ives, the person who designed the iPhone, and the fact that Apple has a new CEO who is going to have to take that company into the future at a time when a lot of people have said they've been somewhat behind on the AI trend. So to me, this actually is a particularly interesting report that I want to get more details on.
Not enough attention on that Thursday report coming from Apple, so looking forward to their earnings later on this week. That's some of the price actions, some of the themes this morning. Let's get you some morning calls. First up, Mizuho downgrading Adobe to neutral, seeing intensifying competition. That stock is down by 1.7%. Your second call from Piper Sandler raising its price target on Blackstone, noting management's positivity on IPO activity for the year. Stock just about unchanged so far today. And finally, BNP Paribas downgrading GE Vernova to neutral. That stock's had a massive run, predicting more difficulty sustaining growth momentum. That name is down this morning by a little more than 1%. Let's talk about the ongoing closure of the Strait of Hormuz, sending fuel prices higher and highlighting the need for reliable energy. Olivia Wassenaar, global head of the Apollo Infrastructure Group, writing, "We see rising need for investment across midstream, LNG and power infrastructure, areas where private capital is increasingly playing an important role." Olivia joins us now for more. Olivia, good morning. Good to see you.
Good morning. Thanks for having me back.
Is it fair to say, and I think it's important to touch base with you on this issue, that this shock in the Middle East is not upending investment, it's accelerating it?
It is. I mean, I think we're all looking at a few things. We're looking at redundancy, right? We're looking at the current infrastructure in the Middle East and maybe where there are gaps, right? You're looking at things around existing pipelines. How do we max out existing pipelines? How do we think about where there's potential for new pipelines? Can you restart old pipelines? People are beginning to talk about things like rail again. So I do think in the Middle East, there's this real focus on redundancy. In the rest of the world, we're looking at where can we compensate. We announced a deal last week for a large Canadian gas infrastructure platform. We believe Canada is a really attractive market right now, especially if you look at what's going on with Canada LNG and access to Europe, access to Asia, really sort of a big part of the broader sort of value chain there. So we are very actively investing in other parts of the energy infrastructure globally.
Well, let's go through the global backdrop and the deals right now. You mentioned Canada. We had EDF over in the UK, RWE in Germany, offshore wind, Ørsted, I believe, as well. I don't want you to pick a favourite baby, but right now, is there a theme that really gets your interest out of all of those right now, of those deals that you think are the ones to watch?
We've really been investing heavily in Europe. We do see this theme around making sure we're giving, again, real redundancy and growth in European power infrastructure. So we started RWE around the grid. We looked at EDF around nuclear. And now we're really focused on offshore wind with the Ørsted deal. I mean, this is a tremendous project. If you look at the number of homes it's going to power across the UK, it's really tremendous. And we're also thinking a little bit about, how do you give really reliable, long-term power to supply to areas that have previously been really dependent on oil and gas from places like Russia and the Middle East.
You have a great lens because in having these discussions and these investments, you have to work with policymakers pretty closely to understand exactly what their appetite is and getting clearance, et cetera, and permitting. Have you noticed a change when it comes to Europe in particular as they try to accelerate some of their reliability, given the supply shocks that have come to them from all angles over the past couple of years?
Absolutely. I mean, we saw sort of the first start of this in 2022 around the Ukraine crisis, right? And that was the first time you saw sort of a pan-European focus on, okay, how do we make sure we're really more prepared longer term? Now with what's going on in the Middle East, you had a big announcement out of Europe last week saying we've got to focus on two things. One, short term around how do we really help the consumers? And then long term around how do we look at better permitting, faster permitting? How do we speed up electrification? How do we speed up things like batteries, which are going to help smooth out intermittency, right? So there's really such a big focus within Europe on how do we make sure that we're taking this reliance away from other areas of the world.
The fact that everybody wants to build at the same time makes things a bit complicated. How much are you experiencing shortages of things like turbines and engines and, the actual pipes and things of that nature, given the fact that everyone is trying to do this at the same time at a time of potential supply chain constraints because of the Strait of Hormuz being blocked?
Absolutely. I mean, it's a real issue, and it's something that we're all grappling with. If in the U.S., for example, if you do not have your sort of components around a new gas plant supplied, you're looking at 5 years, right? That's a long period of time to get to really get the new components in place. So this supply chain is just compounding. And when we look at what we're going to see around the rebuild in the Middle East, whenever this conflict is over, that is only going to add to the need for some of these components.
Every single Middle East country is coming out now basically saying we want what the Saudis have. We want an east-west pipeline. We want to be able to bypass the Strait of Hormuz. Can you get the appetite for that kind of investment when Iran and the IRG still remain a threat?
I do think you're going to need to see some stability, but you saw it out of the EU last week saying, hey, how can we help with investment in the region to really, again, help this redundancy piece? When you look at pipelines, that's helpful for crude, but when you look at things like refined products, like jet fuel, for example, and LNG, these are things that are not going through pipelines. So we need to think of other ways to be able to transport these and really ensure that security.
To get that confidence, though, it's not even just for oil and gas. There's all this money put to data centers, and people now are talking about them having to go underground. Do you still see the optimism for people wanting to be invested heavily in this region?
I do. And the offer on the data center side was very clear for a while, right? I mean, if you look at it, there was cheap power in the Middle East. There was abundancy of land. There was lots of local capital. And for many years, this sort of real perceived political stability. You've sort of taken the last point of that off. I do think you still see the other components there, but there is going to be a little bit of confidence coming back to the region before you see people really wanting to reinvest in this AI phenomenon.
You don't have to worry too much about the political cycle in certain parts of the Middle East, and that's a different conversation. With Europe, maybe you do, and with the US as well. How relevant is the political cycle to some of these decisions?
you see it a lot around, for example, renewable energy, right? And we've certainly seen, I mean, I've been investing in renewable energy for 25 years. You've seen real sort of booms and busts over time. What I will say is it begins to be tied more into security than it ever has before. I mean, again, as we look at Europe, right, this sort of dependency, whether it's on Russia or on the Middle East, and all of a sudden looking and saying, what can we do internally? What resources do we have? We have sun, we have wind, right? These are things that we continue to build up internally. We can look at electrification. So we're, again, less reliant on these commodities coming from other parts of the world.
Do you think there is a bigger focus now on abundance? I just wonder to what extent the conversation really has changed. Lisa mentioned that. It seems to me that everything's become very polarised, that for certain political groups, particularly in Europe, they believe everything that is fossil fuels or touches fossil fuels is bad, and everything that's renewable is fantastic under any situation, in any circumstance. And for whatever reason, the other side sees it completely differently. Do you think we have got some kind of moment here where we can just accept we need something from both worlds? We need abundance.
I think that's absolutely spot on. Right now, you're looking at a crisis, right? And everyone is trying to figure out how do we fix this, right? If you look at Europe, Europe has spent about $25 billion over the last few months since the war started to get the same amount of energy supply they had before. So they're looking at it saying, gosh, rather than making this highly politicized, let's figure out, again, how we can have homegrown energy supplies so that we're not dealing with these massive price shocks going forward.
And energy bills have been moving in the wrong direction, particularly in places like the UK.
Yeah, and that's the reason why you see, for example, some pension funds that previously couldn't invest in the fossil fuel industry suddenly allowed to invest in the fossil fuel industry because they're realizing, wait a second, we kind of can't deal with all of these things at the same time, and we need the returns.
Made some stupid investment decisions, or rather stupid policy decisions in Europe for quite a while.
Going forward, how much does this change exactly what this looks like, and how quickly can you enact some of these things? I think that the supply chain constraints are actually a really, really thing. So I was talking to someone who is building a power plant, and they said, we can't get the engines. We can't get the things.
GE Vernova, we mentioned
GE Vernova.
Yes.
Right. I mean, that's the main constraint for GE Vernova, is that they can't get the materials quickly enough to build all of the engines and the turbines that people want. When you're dealing with that kind of issue, how quickly can you become reliant on yourself? And that, I think, is going to become increasingly political.
And there's a rush for the whole world to get their hands on the same stuff. When it comes to Europe, though, the own goals. Remember, they restarted coal and wind down nuclear when Russia invaded Ukraine. Nuclear at one point was supplying 20%, 25% actually more of Germany's electricity.
Crazy. Olivia, good to see you. Thanks for being
nice
here.
To you as well.
Thank you so much. Thanks for the update. Olivia Wassenaar there of Apollo. Up next, Greg Daco of EY on the path ahead for the Federal Reserve. Plus, Yahira has your morning movers. Another look at Qualcomm this morning. They're stopping the pre-market up by close to 11%. Equity futures right now in the S&P pulling back from all-time highs. We're negative by about 0.1%. Similar move on the Nasdaq 100 this morning. Within the Nasdaq, some major moves, particularly from the likes of Qualcomm. Let's get you an update on some single names, including that one. With your morning movers, Yahira has more. Hey, Yahira.
Hi, John. We start with Qualcomm. As you said, shares are soaring nearly 11% in the pre-market on this report that it is working with OpenAI on a smartphone, something that we know OpenAI has been interested in ever since it acquired Apple legend Jony Ive's startup last year. But John Krinsky to you all earlier, flagging a warning sign in semis tied to this name, saying that when even laggards like Qualcomm start catching a bid, it can signal the rally is close to its final innings. But for now, it is going strong, and it is showing up in names like Micron and SanDisk, both up in the pre-market after a bullish call from analysts over at Melius Research. They initiated coverage for both with a buy rating, saying that there is no denying that memory is becoming a core part of the AI story, and they could see demand for years to come. And we end on Verizon, which just had earnings. Shares are up 3.3% in the pre-market. It was a beat and a raise over there. The largest U.S. wireless carrier posting a gain in phone subscribers, surprising the market, which was expecting a loss. Also, this showing that there is early traction under a new CEO that just took the helm 6 months ago. John?
Yahara, thank you. Thanks for this morning. Looking ahead to a big week ahead, including lots of tech earnings coming on Wednesday and Thursday. Also on Wednesday afternoon, a Fed rate decision and Chairman Powell news conference. Bloomberg's Mike McKee joins us now with a preview. Good morning, Mike.
Morning, John. Can you believe we're here? This week, Jay Powell's last news conference as Fed chair, probably. It looks that way after the developments over the weekend. Tuesday, we start with the Fed meeting, and then on Wednesday, we get the decision at 2 p.m. and at 2:30, Powell's news conference. And because Kevin Warsh is likely to be approved by the Senate Banking Committee earlier that morning, it would mean that there are not going to be any questions about who's going to be chair pro tem. But it very well could be that the first question asked is, are you going to stay on as a governor? Because the Fed's not expected to do anything. Going to leave rates alone. There's no summary of economic projections, and there is no dot plot. The question then becomes, when does Warsh get actually confirmed by the Senate? They have to wait 24 hours under Senate rules, so it could be Thursday, but they've got an awful lot going on the Senate floor, including trying to get the DHS funding through, the reconciliation bill. And so it may be a week or two or longer before they get there, but he should be confirmed by the 15th. It's also the central bank week around the world. Celebrations in Canada and Japan, the Bank of England, the European Central Bank, 4 big central banks, including the Fed, 5 central banks, and none of them at this point expected to do anything because we're back to talking about what's Donald Trump going to do about Iran, and nobody knows. So for now, everybody is on hold. We do have a big backloaded week of economic data. Might help the Fed make a decision, but it all comes after the meeting. On Tuesday, we do get consumer confidence, but Wednesday, things that don't matter as much, trade, housing starts, durable goods. Thursday, though, income spending and the PCE inflation index expected to rise because of oil prices. The employment cost index, they want to know what's happening with wages in this situation. And first quarter GDP, fourth quarter GDP revised down to just a 0.7 gain. How much more do we get in the first quarter? And of course, jobless claims. And then we kick off May on Friday with ISM manufacturing. A lot of interest in whether AI is still propping that up. So a lot going on this week. I'm not sure at the end of the week how much different things will look. But it is going to be very interesting, especially to say goodbye to a guy who's been chair of the Fed for 8 years.
Well, let's talk about whether we're actually going to say goodbye to him. As Fed chair, yes, but on the board, a different question, Mike. Transparency and finality. The chairman's own words. Do you think we met the bar for that at the DOJ?
Yeah, I don't think so, because Jeanine Pirro appended her comments by saying she would feel free to refile criminal charges if there is anything in the IG report. And we know, since there was nothing in the first time she was looking at this, that she might just make something up. So for Powell, I suspect he will want to stay on until the Inspector General's report is out at least. That could come quickly because they've been working on it since last July. And maybe he wants to stay on through the election to see what happens with the control of the House and Senate and what legal jeopardy he might find himself under.
Mike McKee, thank you. Looking forward to the news conference and your questions that will be presented to the chairman Wednesday afternoon. Greg Daco of EY writing this: the Fed will keep rates unchanged this week. That's the boring stuff. Even once Warsh is confirmed, here's the fun stuff. Powell may remain on the board as governor to preserve a degree of institutional continuity. Greg joins us now for more. Greg, good morning.
Good morning, John.
What do you mean by that line, institutional continuity? Is it needed?
I think so. I think it's very much needed at a point where we are facing financial difficulties in terms of what's happening in the Middle East, where there are questions around the direction of economic travel, and where this type of transition in terms of Fed leadership is likely to carry a number of potential institutional changes. We know Fed Chair Powell has been very clear about the need and the desire to preserve that institutional credibility. And at a time when there's going to be likely increased political influence, even if not direct, indirect, in terms of the way the Fed is conducting policy, that's going to be critical. And I think that's going to be the key reason why Fed Chair Powell says that he will stay on as governor for the foreseeable future.
Do you think Wednesday's the appropriate time and forum to communicate that?
I think he will distance himself from communicating that at the press conference. We saw it last time around when he was very clear as to what he would do should there not be a nominated Fed chair to replace him. He would stay on pro tem. But the key question as to whether he stays on through the end of his governor term, which lasts until the end of January 2028, is likely to be an open question, which he likely communicate via a statement that will be made apart from the press conference.
You said that this is a particularly important part for the central bank, given potential disruptions. Every market analyst that comes on seems to think very much the other way, that central banks are almost the least relevant they've been in years, and that, frankly, they just need to remain on hold, and everything else will do the work for them. Why do you disagree?
That's the policy angle, and that's very right in terms of how policy is conducted. Policy is not going to change much. We heard it from Mike McKee in terms of the different policy statements that will come out from the different central banks around the world. We're going to see most central banks be on hold because we're facing a supply shock, and central banks don't like to deal with that. So the best way to deal with it is essentially not do anything in terms of policy. But when it comes to the institutional framework, when it comes to a Fed chair nominee that has said that inflation is a choice, I think that's a different type of question. It's a policy question. It's an institutional question, as to how the Fed will conduct monetary policy in that environment. Now, we know there's an FOMC committee. We know it's not just one person deciding on policy. But I think when it comes to the potential for influence on the Fed's structure, on how the Fed is organized, on how the Fed sees any type of forecast, on whether inflation is a choice, those are all questions that are institutional. And I think Fed Chair Powell will want to preserve some institutionality in terms of how he guides policy.
What you're saying is really interesting, and is something that I haven't heard before, which is the reframing of the Federal Reserve and the reshaping of it that a lot of people say Kevin Warsh plans to do. He says himself he plans to do, shrinking the balance sheet and using Fed policy a little bit differently, that Fed Chair Jay Powell, when he leaves as that position, will want to stand as governor to have a say in exactly how the Federal Reserve gets reshaped. Is that correct?
That's absolutely correct. If you remember in 1948, very few of us do, but in 1948, Fed Chair Eccles stayed on the Fed board as a governor, and he stayed on for 3 years. Why? Because he wanted to ensure Fed independence. And during the war and after the war, the Fed was pressured to buy government bonds to finance the war. That him staying on the board for another 3 years led to the Fed Treasury Accord, which gave the Fed today's independent framework. I think Powell will want to do the same in terms of preserving Fed independence.
1948 was a very different time. We were coming out of the war. Was there more agreement around that than now? And a lot of people would view it as much more controversial.
Well, I think the Fed independence is very important in terms of what it does to Treasury yields. And we are in this environment where interest rates are remaining higher. I think one of the key characteristics of today's financial market is that despite the Fed having eased monetary policy for the past 2 years, we continue to see long-term rates higher than they were when the Fed started to ease. And it's not just a U.S. story. It's a Canada story. It's a European story where long-term rates are staying higher. I think we want to preserve the risk of this type of situation where there is a sentiment of political influence on the Fed that pressures up long-term rates, and anytime there is some kind of shock, like the Middle East shock, we see further rises in long-term rates.
But if Powell stays, doesn't he look political?
He doesn't look political in the sense that he's staying on as a governor, and while it's not been done...
But that's not president. He'd be breaking president of the Federal Reserve.
Yes, but he'd be staying on as he is allowed to do as a governor. So it's not necessarily political in the sense that he's doing something that has a political motivation. He's been very clear about his intentions to stay on the Fed and avoid any type of political influence on the Fed. So staying on is not necessarily a political move in that it prevents any type of political or perceived political influence.
Doesn't that get confusing for market participants if Jay Powell, governor, comes out and gives speeches while Kevin Warsh, now chairman, is supposed to be leading that communication effort?
Potentially. I mean, there is going to be communication issues, but we've heard from nominee Kevin Warsh that he wants to reduce the amount of communication. He wants to have more discretion on policymaking when it comes to decision at the Fed. So I think having another voice at the Fed that preserves that stability in terms of the institutional framework is not necessarily a bad thing for market participants. If you think about it, there is a risk that we have less communication, less transparency, less forward guidance, and more anticipation of what might happen in an environment where perhaps we're going to see AI-driven productivity growth leading to lower inflation, which is the Kevin Warsh's main argument in terms of easing monetary policy. So I think it preserves some stability.
The intentions are good, the consequences are unknown. That's kind of where I'm at right now. I understand the intentions behind it, but it could create a dependency issue. The thing that I don't quite understand with the chairman, and I hope someone will ask him in the news conference, the things that he's worried about aren't priced in this market at all. Lisa's talked about this. Inflation expectations have been really well anchored throughout all of this. So either Chairman Powell's really off base or the market's priced very badly. Because I don't think inflation expectations are anchored because they believe Chairman Powell's staying around forever. I think they're just anchored because they believe in the institutional resilience of the Federal Reserve. Is someone getting something wrong here?
Perhaps, but let's also take a look at the Middle East conflict and where oil is pricing in terms of the financial pricing and where the real barrels are being priced. I mean, that's another major disconnect in terms of how financial markets are anticipating the Middle East conflict will evolve. So I think we have to be a little bit careful with the pricing because there is always going to be some institutional credibility. I mean, remember, this is the FOMC. It's not just one person deciding on policy, deciding on the institutional framework. It's a consortium of individuals that come up with a consensus as to policy, as to the institutional framework. I think the fear right now, and this is a mathematical calculation in terms of how this will play out, is that we end up with a situation where we have more governors that are essentially Trump nominees and that do not hide away from this political influence in reshaping how the Fed is structured. So it's not necessarily an on-off type of bet. It's there are this many odds that we may see the situation where we have more Trump nominees that lean in a certain direction in terms of reshaping how the balance sheet process is conducted, how the institutional framework is conducted in terms of communication, in terms of potentially the 2% target. A number of things are on the table right now.
This was thoughtful. Greg, appreciate your time. Thank you. Greg Daco there of EY. Equity futures slightly softer. We're down 0.1% on the S&P with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Iran's foreign minister is meeting with Russian President Vladimir Putin in St. Petersburg as talks with the US remain at an impasse. Iran has signaled it might accept an interim deal where it reopens the Strait of Hormuz in exchange for Washington ending its blockade of Iranian ports. Eli Lilly has agreed to a $2.3 billion cash deal to buy Ajax Therapeutics. Lilly is ramping up its efforts to build a portfolio of breakthrough cancer therapies. This follows a $7 billion deal Lilly reached last week for cancer research startup Kelonia Therapeutics. If you're dreading your next trip to JFK Airport, some exciting news may potentially lift your spirits. Aviation startup Joby is planning to fly electric air taxis between JFK and Midtown Manhattan. The plans are described as 100 times quieter than helicopters, and if all goes well, passenger flights could begin as soon as the second half of the year. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate the update. Up next, we'll set you up for a busy week ahead. Plus, we'll catch up with Dan Niles of Niles Investment Management with the preview of big tech earnings from New York City. You're watching Bloomberg TV.
This sort of price appreciation is vulnerable to a near-term correction. The fact that we've seen a 40% move in the last couple weeks in some of these names, it's likely to give back a large portion of that. It doesn't mean we're going into a bear market for semis, but I would expect a pretty good retracement once this kind of blow-off completes itself.
That's one view. That view is Jonathan Krinsky's of BTIG on a record run in the chip sector and why he thinks it's going to correct in equal and opposite fashion. Equity futures this morning, negative by 0.1% on the S&P 500, just about unchanged on the Nasdaq. Heading into this week, and what a week it's stacking up to be. This is your week ahead in our trading diary, taking place a little bit later on this afternoon. President Donald Trump meeting with King Charles at the White House. Tomorrow, earnings from UPS and JetBlue. JetBlue gets a bit more interesting, given American Airlines has dropped out of the race to be acquired by United Airlines. United still might be interested. We'll talk about that through the week. Wednesday, a Fed rate decision followed by a Chairman Powell news conference. We'll also get a Senate Banking Committee vote on Kevin Warsh at some point in the week, hopefully. Plus earnings from Amazon, Alphabet, Microsoft and Meta. Thursday, another round of jobless claims, core PCE and results from Apple.
Yeah, look, big tech, first and foremost, is going to be the main event for this week, given the fact that this entire rally, this record rally that we've seen, has been predicated on results being really good and announcements. I do wonder whether we get some interesting political intrigue. And then I actually am interested in the data. I know, call me crazy, but I want to see if inflation is ticking up and if wages are ticking up as well. Torsten Slok of Apollo putting out a note this morning saying if you look under the hood, wages are starting to pick up. They're creeping higher. They're listening to you.
Yes. Ask for a pay rise. Every single time. It's what you should do.
Yeah, wage price spiral. Personally, John's result.
Better than
the worst
the
they can say
right?
is no.
100%.
Come on,
Obviously.
the worst they can say is no.
Exactly.
Guys.
Exactly. Wage price spirals, the only person who has a problem, the only people who have problems with wage price spirals are economists. No one else. You'll never find anyone else that has a problem with that. That's for sure. Let's talk about tech results. This is from Dan Niles of Niles Investment Management writing, I believe all of them will beat estimates. Expect accelerating AI-related hyperscaler revenue driven by the surge in agentic workloads, which is just beginning. Dan joins us now for more. Dan, appreciate your time. I want to start with a sector that you know better than most, and that's the chip sector and this 18-day record run that we've seen. Dan, why do you believe the exuberance is rational?
Well, I think if you go back to the AI cycle, the first couple of years, it was all about spending money on training. Then last year, it was on these chat-based AIs. But what you saw at the end of November of last year was this product come out called ClaudeBot that then morphed into OpenClaw on January 30th. And that's the beginning of agentic AI. And that requires 10 to 100 times more tokens than what you had with these chat-based AIs. So if you need that many more tokens to perform that, you've got another big uplift in demand from that. And you saw an indication of that last week with Intel's results and how well it's done. And I've written about that starting back in March on how microprocessors was the next bottleneck because agentic AI required all this orchestration. If you, Jonathan, say, hey, go to the SEC website, pull this data, go to Bloomberg, pull this other data, go to Yahoo Finance, pull this other data, and then put it all in an Excel spreadsheet, that's a lot of different API calls, a lot of different things you want it to do. And so the bottlenecks keep switching, but it's also a ton more tokens versus just asking it a basic question. So I think that's why you've got another surge coming in the chips sector. And obviously, there's going to be some pullback, right? You had 18 up days over which the semiconductor index peak to trough was up 49%, 47% on closing basis. If you look at the other streaks, there were 4 of them between 2014 and 2017. They ranged from 10 consecutive up days to 15. The gain was between 8 to 9%, not 47. So, will you get some pullback? Sure, 5 to 10%, easily see that. But I think the chip sector probably ends the year higher than where it is right now.
Dan, would you agree with Russ Koesterich of Blackrock, who came on earlier and said he thinks it's going to be a different kind of reaction in markets to any CapEx plans announced by some of the big tech names, that it frankly will be rewarded again rather than punished?
Well, he's going against what we just saw last week. I mean, if you look at Tesla, the stock was up in the aftermarket. Remember, Tesla beat the revenues, they beat the EPS. And then when on the call, they said, yeah, we're going to spend $25 billion in CapEx, not $20 billion. The stock then rolled over from being up to down. And I think it finished the week down somewhere around close to 5% or so in a solid week for the market overall. So that gives you kind of a hint of how the market's thinking about this, which is it cares about cash flow. And you just saw it with one of the Magnificent Seven. So that's, there's a whole slew of risks. So on the one hand, I think all these companies are going to beat the March quarter. The problem is the guidance, which is why I don't particularly want to have much involvement with any of the names, because would it surprise you to hear how close rates on big deals were a problem? Because don't forget, the market was at a 52-week low, I think, on March 30th. And so for some of these software companies, you could have an issue with that. You saw that with ServiceNow. Semiconductor prices skyrocketing, impacting margins going forward. Oil impacting shipping costs for companies that care about that, like with an Amazon, or ad budgets where you hear either Google or Meta saying something like, well, because of the uncertainty, these big consumer packaged good companies have pulled back a little bit, or the pull forward in demand because prices have gone up so much, that impacting the second half of the year. And you heard that from Intel with relation to their non-AI related businesses. So these are all things that, yes, are they all going to put up great numbers? Absolutely. Could you have a real problem with guidance that causes all these stocks on average to go down on the other side of it? By the way, these 5, they went down 1% on average after they reported results the next day.
Yeah.
The prior quarter. And so that's something you need to think about. And after this massive run, I really am going to back away from most of these, with maybe the exception of, Google, which is my favorite.
Dan, just curious quickly here, how much do you see one particular name as more exposed to some of these potential risks, in particular, higher oil and shipping costs?
Yeah, I mean, I think it varies, right? With things like higher oil, obviously that matters for Amazon's logistics business more. Memory prices matters for a company like Apple a lot that ships those. Ads, obviously, it's Google and Meta. So I think for each one of these, and for close rates, you've got that affects software the most, which would impact potentially Microsoft. So for each of these names, it's a different risk profile. And the Magnificent Seven are up 20% on average since March 30th. The S&P is up 13%. As we talked about, the SOX is up 47%. And so I think for right now, I'm looking for some kind of minor correction. And the way I've phrased it is, this is a lot like 1997 or 98, where you had the macro scare off the Thai currency crisis. S&P went down 11%. Then you had the scare in 98 off the Russian bond default. S&P went down 19%. But it finished both of those years up 31 and 27. Once you got through that, I don't view Iran much differently from a longer-term basis.
Dan, interesting framing. Appreciate your time, sir. Dan Niles there of Niles Investment Management. A lot to unpack there. There are obvious secular tailwinds supporting this market right now, and Dan was talking about what's going to happen with agentic AI and how supportive that will be of some of the things that are supporting this rally in chip stocks. It's the cyclical components of some of these stories that I think we have to focus on going into the Wednesday reporting season for these guys. And that's the ad sales at Alphabet, the ad sales at Meta. Just how well has that held up in the face of this uncertainty worldwide?
Yeah, as Kristen Bitterly was saying earlier of Citi, essentially people can only focus on one thing at a time, and they're focused on the AI promise over the longer term. There will be some sort of blowback and repercussions from what we're seeing in the real world that we could see reflected and potentially penalized.
Exactly. Or higher oil prices may be starting to bite, supply chain risks, a lot of questions even for the tech names.
Coming up tomorrow, looking forward to catching up with John Stolfus of Oppenheimer, the General Motors CFO, Paul Jacobson, Seth Carpenter of Morgan Stanley, plus Lindsay Pieksa of Stifel from New York City this morning. Good morning. Thank you for starting your week with Bloomberg TV. This was Bloomberg Surveillance.